Okay, so we're going to answer questions. David Ryan is actually on IBD Live right now, and he's finishing up in about 20 minutes or so, 30 minutes. So he'll be here just after he gets off of IBD Live. We're going to be answering questions for the better part of 2.5, maybe even 3 hours, I think. So we're going to go a long time, but as Bob said, that we do have many, many hundreds of questions. Usually by the end of the Master Trader program, we've got thousands and thousands of questions. So it's impossible to answer all those questions. But a lot of the questions are either similar or almost exactly the same. We'll get sometimes 50 questions that will be the same question. What do you do to hold through earnings? That might be 100 people might ask that same question. So what we try to do is aggregate the most popular questions first, and then of course try to get to as many as we can. I will be going through to the workbook, and I can be go to look at pages if there's questions about specific pages in the workbook. So I'll bring that up, and let's see here. All right, so we'll have that, and then also I do have my live charts that are up here, that if I want to go to a live chart, we can take a look at that if there's some examples. But I'm not going to be answering any questions as far as if you enter ticker symbols in. We're not doing that today. Live trading, we'll talk about individual stocks and look at things live. But if I have to make any examples, I can do that here. Let's see here. So here's the workbook. Let's see. I'm trying to think if there's anything else. I do know. Oh, so Bob, you did tell me about, I guess someone told someone that they were chasing a pipe dream. Bob was just telling me that someone commented that someone told them that they were chasing a pipe dream, trying to be a trader. So I kind of take that as a compliment because at least there's dream is in the equation there. So I'd rather be chasing a dream than chasing a job. But just want to, I'm sure everybody told Elon Musk that too about Tesla. I mean, still to this day, people just can't believe that Tesla is doing what they're doing. But then I'm sure every athlete and musician and artist in history has been told that. So again, I was told that too, not from my parents though. My parents were actually very supportive of anything I did, but I was told from everybody, that it was gambling and that I should have something to fall back on, and that it was very, very unlikely that it would work out. Yeah, it is. It's very unlikely that anything great is going to come to fruition because most people aren't willing to do what it takes. Being a great basketball player, football player, trial attorney, surgeon, it's all a low likelihood. So, but that's why should we, lower our standards because everybody else does? So anyway, just wanted to tell you if that's the type of comments you're getting or advice you're getting, just realize one thing. Ask if that person accomplished what you're trying to accomplish. And I can tell you right now, 100% of the time, the answer will be no. And people who haven't done it themselves can't imagine that somebody else can, because of course, that would not make them feel too good about themselves if you could do something that they can't. So just keep that in mind, that those words never come from someone who's accomplished it. And someone who has accomplished it would never, ever tell you that because they already know. They've already seen. They already know the possibilities. So anyway, let's start off with some questions.
Mark, I just have to interject. I am glad you failed at being a professional drummer. So thank you.
That's true. Bob, a lot of people probably are. I didn't fail though. Actually, I was a very successful professional drummer.
Well,
there just wasn't enough. There just wasn't the level of money that I wanted in it. And there was more money I thought in the stock market. They asked the famous bank robber, I forget his name, why did he rob the bank? And he said, because that's where the money is. So right. Yeah, and that's what I always tell people whenever young kids or something ask me. First of all, if you want money, you have to go where the money is. You have to go in the direction. You're looking for a sunset. You can't head west, or actually, you can't head south. You have to head west. Yeah. You're looking for a sunrise. You got to head east, right? So again, you got to be going in the right direction. But anyway, so let's start off with some questions here. And,
one of the questions that I didn't. That I wanted to start off with, just jumping off of that point, Mark, is somebody just asking about your course background, dropping out of school in 8th grade, didn't go to high school a day of your life. And, what was it about you that allowed you to have, that lifestyle or the character to really have that drive to obviously achieve, particularly in the stock market, the successes you did? What was the catalyst, or how did you turn that corner from not pursuing school and the traditional way of learning to how you did become successful with the stock market?
Well, first of all, the first answer is because I had horrible influences. My parents didn't go to college, and my father was not a very good influence on me as far as work. He was actually very hard worker, and he ran a restaurant, but just had a lot of bad influences, and was in a situation with lots of crime and just dysfunction and violence and all kinds of crazy things. So I was never taught that school was important. And I was a musician, and I wanted to, that was my goal. And I left school to be a musician. I ended up having a recording studio, and I was actually very successful at it. That's what I banked my trading with, was and the money that I made from being a musician. And I sold my recording studio, paid off all my bills, put the money into a trading account. So I worked my way up very slowly. But yeah, I mean, as far as, I don't know. I'm not sure if that's something innate or not, but I know one thing: I started off, very ignorant and with no education and no resources, no money, no resources, nothing but bad mentors. And so I just I started listening to Anthony Robbins. Dr. Wayne Dyer was my life coach. I went to every seminar that I could go to. To this day, I still have all the cassette tapes from back in the early 80s. I've got hundreds of cassette tapes, and I even have hundreds of CDs. And I spent my last penny I would spend on going to an Anthony Robbins seminar, or going to, I can't even count. I've literally been to probably well over 100 seminars and read well over 3,000-4,000 books. Right behind me, right here, right now, I have 4,000 books in my library that are sitting right behind me right now, and I've read every single one of them. Some of them 30 or 40 times. So I mean, just a long road. I'm 50. I'll be 57 in January. You can accomplish quite a bit in 57 years. It's quite amazing. You can accomplish quite a bit in 10 years, but in 50 years, it's a long time. So,
Mark, let me ask you, because a lot of kids don't finish high school. A lot of kids drop out. They don't watch these seminars and these tapes and read all these books. What was it that drove you? How did you have something, though, that just allowed you to say, even though I didn't have all the benefits of what other kids may have,
right?
How did you have that drive? What was it inside you?
Poverty, extreme poverty. I mean, that's the real answer. I didn't want to be like my mother, who cried every night over money, and was constantly stressed out, and constant arguments about money. And I didn't want to live like that. I wanted to have financial freedom. I never cared about possessions. I just cared about having financial freedom and not having to struggle. So yeah, looking back at the fire, and not wanting to go back into that fire, that'll keep you going. So
yeah, motivation. Okay. and dedication. We all know that.
Yeah.
So Igor wants to know, to get started, what is the earliest you would buy a stock after an IPO, if not on the IPO day? And what is the optimal length of the IPO base?
Right. That's a good question. We have a whole section on IPOs coming up. So we're going to have a section which we call the primary base. And we're going to answer that in depth and show you lots and lots of examples. And that's one of your greatest opportunities when you have an IPO. This is the earliest that you can get on board a company, right? So imagine if you bought the IPO or near the IPO on Amazon or Netflix or Google or some these big winning stocks. Although keep in mind, most stocks don't go on to be a Google or an Amazon. So the answer is, though, I want to have some type of trading so I can apply the same rules. Now you're not going to have a confirmed uptrend in an IPO that maybe has consolidated for 3 or 4 weeks or even a couple months. you're not going to have 200 days. So you're not going to be using that trend template for that. You're going to be looking at just the chart. But I generally want to see, weeks of consolidation, weeks of price action. I'm never buying on the IPO. I'm never buying on the IPO ever. Never just buying. I don't buy pre-IPO. A few times I've gotten some pre-IPO stock that they've given me at one of the brokerage firms, but almost never. And it's a very small amount. But yeah, so we're gonna cover that in absolute extreme detail coming up.
And just similar to that, what do you do about an RS rating where an IPO for within the first couple of days won't have something that would be relevant or significant?
Well, in the first couple of days, I wouldn't look at it, first of all, but you can still have an RS rating that could be high coming out of an IPO. Of course, if the lesser amount of data you have, that will render that ineffective at the time. So that's another reason why it'd be nice to have some price action, so you can then and you know what? I just noticed something. We got this screen. Oh, okay. I'm sorry. I just wanted to say, well, I'm sharing screen. I just didn't know why we weren't full screen with the cameras, but it's because I'm sharing screen. Yeah. So again, you can have. I would like to see the IPO RS. I'd like to see it be as high as possible. No different than any other stock that I'm trading. But will I trade them with a lower relative strength? Yes, I will. And if David was here right now, maybe we can revisit this. The really great IPOs or the great opportunities in IPOs usually happen or very often happen during corrections in bear markets. This is where, because what happens is you get the IPO while it's building a base and holding up, it builds up that relative strength, but you get some of the better merchandise when you coming out of these corrections. And of course, then you get an ensuing bull market subsequent. So, that tide carries all boats. But like now is a perfect example where there's a lot of IPOs coming to market, and this is a business. The stock market is a business. You have to realize that. And when there's buyers, they, just like right now, they're just building houses everywhere, at least where I live, because there's an appetite for homes, right? There's a lot of demand. And when there's no demand, nobody's building any homes, and you can get someone to do a job around your house very easily. Now you got to wait forever to get someone to do construction because they're so busy. So the same thing with the market. It's the business dynamics are exactly the same as any other business. When there's buyers, they issue stock, and that's a sign of froth. When you see lots and lots of IPOs, we're just seeing tons of IPOs here. And I think that's another sign of froth. And you get a lot of crap that starts to come to market. This was in the .com craze too. If all you had to do is just put .com after your name in the 1990s and the late 90s, and the stock blasted off. But most of those companies went under and went bankrupt and are no longer with us.
A question being asked with regard to the length of a base to develop, where bases are 7 to 65 weeks, generally speaking. What's the earliest a 3C or even better, a low cheat could take to develop?
Well, I answer this in my book. So in both books, I talk about that. And, it could be any length. You can have a cheat area form on an intraday chart pattern. So it really depends on what your time frame is if you want to short-term trade something. But looking at what's a sound base that could make a decent sustained move, you want in the cup patterns or the correction. I call them correction patterns that have a cheat or a low cheat, a cheat or a handle. Those are what I call correction patterns. And then consolidation patterns would be more flattish and don't have the corrections in them. Those can be 4 or 5 weeks. We call them a Darvis box after Nicholas Darvis. 4 or 5 weeks or so, you start getting into the correction patterns. You'd like to see 7, 8 weeks minimum. 12, 13 weeks is a decent sized base. You start. I prefer. I love the 6-month, 12-month bases. The thing to remember is that they're a function of the market. So when you have a big bear market, you're going to have deep bases and big cup with handles. When you have a shallow market, you're going to have shallower patterns usually. When you're already in a bull market and it's been running a bit, you're going to get flat bases. You're going to get when you get these small consolidations and the pullbacks only last for a number of weeks, you're going to get shorter bases. So it's more of a function and a theme of the market. But I mean, I'll show you a stock, and this isn't the best. We're kind of scraping the bottom of the barrel right now, I think. But this is the stock that I just bought yesterday, and we put on our MPA platform. It had you can see a great breakout, and it actually had a fairly decent close. It didn't close up at the high, but it closed up quite a bit. It was very, very tight. The reason I bought it was because it was so tight. But you can see this is going back June 1, 2, 3, 4. This is about a 5, almost a 6-month base. Look at that volume. You want to talk about the 1-2 punch? See, again, everything I'm showing you, there's nothing different. I mean, this is what I'm doing. So a lot of people have asked about U.S. Investing Championship. Have I changed my strategy? No, but see, here's a perfect example of how, even from a daily chart pattern, you could be day trading this. You could be short-term trading. I mean, it comes out here, and this is actually a pretty nice quick move, right? I mean, if you're buying it on the breakout, and you could be selling it here. Now, this looks bigger than it is because it's so tight, but it ran up about 7%, for the day. That's an actually, for a short-term move for a day trader, that's a gigantic move. That's huge. But look at the 1-2 punch, right? See the volume? See how it comes all the way down. It's almost the lowest volume since the whole in the entire base, right? That one day right there, just before it breaks out, 2 days before it breaks out, is just about the lowest. It might be the lowest, but it's one of the absolute lowest days of volume in the entire base. It's just, once again, supply demand. There's where the water came out of the towel, and now it has explosive potential. So now, bang, comes popping out. Now watch this, because I know we've had some questions about where to draw the line when you're looking for supply. You start at the pivot. See, right here's the pivot. So you don't look back and see and start drawing it from left to right. A lot of people draw it from left to right, and they start it at the left of the base. No, you start at the pivot, because you're trying to find out, where does the pivot intersect? So you're looking at this, say here, right, before it breaks out. So I'm going to draw the line right here. I'm going to move it up a little bit. Hold on. Right here, right? So I'm going to draw it right at the top of this pivot right here. Okay, so now that tells me that that's the line of least resistance, right? Once we can get through there, you can see this is where it's bumped up to. Now, when I go backwards and I look back, I can see where the supply is. Now, if this was a very deep base and we were coming off of a cheat down here, I would draw that line across. Let's just move this down, say down here, right? I mean, there's no pivot here, but actually right here, we can use this right here. Now you see, when we draw it across here, now we see, okay, there's a little supply right here above the line. If we went lower, and we're down here, now you see the supply, there's more supply, and the supply gets closer to the buy point. So now you've got more of a supply issue. All right, so that's how you do that. All right, just wanted to give you a little example here.
Yeah, we do have that question, so you just took care of two with one.
Okay.
Do you ever consider the price action of a stock during after-hours trading? Do you have that up on your charts? And do you ever use stops for after-hours trading?
I don't. I almost never trade pre-market or post-market. The only time that sometimes I might is if I have maybe a stock I held into earnings and it has a gigantic move, and after the close, they announce earnings after the close. I might sell some in the aftermarket, but almost never. Virtually never. I'm only usually looking at that and aware of that. In the morning, I check all my stocks and I see if there's any gaps, of course. So I'll see that pre-market trading. And in post-market, I'm only checking if there's earnings. If there's earnings and they came out after the close, then I take a look at what's going on, because I want to see the initial reaction. And then I want to see how the next day it acts. A small little nuance here. I prefer earnings to come out after the close as opposed to pre open. And the reason why is because after the close, you get the night to digest. You get some time to digest the news and for things to sort of some equilibrium to sort of, come back into the stock. When it's pre-market, now, if it just explodes and comes out of a base, that's good. A pre-market earnings announcement can facilitate that, but it also a lot of times you'll get where they initially gap up on the market and then they come crashing back down. So there's going to be more of that initial reaction doesn't have time to digest the information as much.
There were a lot of questions we got from people regarding taxes and tax implications. How much do you make decisions on your trading based on tax issues or
Zero.
tax rules?
Yeah, zero. I don't. And I remember, O'Neill used to get these same questions a lot at workshops and seminars, and David too. And the answer has always been the same for all of us. We're hoping to pay lots of taxes. I mean, I'd like my percentage to come down. I would love them to lower the tax rate and bring the percentage down. But my goal is to pay lots of taxes, because that means I made lots of money. So as far as, why would I mean, some people hold the stock and they don't sell it because they have to pay the taxes, and then they end up with, giving back 50% of their gain, and they would have been better off to hold it. So, to me, I'm whatever the taxes are, I'm going to pay the taxes, and I'm hoping to, have taxes to pay. So I don't make any decisions on taxes whatsoever. I just, it's all based on the stock, and I'm just trying to make a profit. And then, the tax situation is the tax situation later.
Yeah, the one thing you don't have with trading is a job. You're exchanging hours for money, but in this job, it's completely scalable, unlimited scalability, if you will. So you're not limited by the number of hours you can work. Pay taxes, be happy to pay taxes. That means you're making money.
True.
What would you see in the weekly? What do you see in the weekly charts that you're not able to see from the daily charts?
Yeah, I think we talked about this yesterday, but it's good let's go over it. So let's take a look here. So one thing I'm looking, let's just take a look at this recent stock. And so here's the daily, right? Now I always start with the daily, and I want to see the daily set up, and I can really see those individual days. Like I can go down here and see how the volume came down and really light on those last few days. So I'm really getting forensic on it and really trying to time that entry point. I want to time that entry point perfectly. And that's what, why I termed what I do specific entry point analysis, because I'm trying to line up everything to an absolute specific one day that the stock is wrung all that water out of the towel. The supply is gone. The line of least resistance is formed, and it has explosive potential, because number one, I want to be at a profit right away. And I want to time that stock just before it's going to make a very fast or big move, because I want to compound as rapidly as I can. So time is money. So I get to see that granularity, if you will, within the base on the daily. Now, but there's some noise in there too, right? And also, if you want to see a little bit more the institutional footprints, you can see some individual days. Like we see this one day right here where it broke out. We've got this giant increase in volume. That's great. That's great. We look at the weekly. We can also see, look, the weekly volume is big. So that means that the entire week, and then we haven't even. This is a good sign, because we're only at halfway through the week, and we're already above average weekly volume. So that's good too, right? We're seeing good weekly volume. But what I look for mostly when I look at a weekly chart, I'm looking for the base, and I want to see, I want to see the consolidation look just as good as it looks on the daily chart. I'm looking for tight closes on the right side. I want to see tight closes, and tight closes around all the little consolidations around the cheat areas, or all the consolidations. You want to see tight weekly closes. This is something that O'Neill talks about, and I think there's not many books that I would recommend to read, and I think that you'll start diluting yourself if you read too many books, and you'll start going in multiple directions. But O'Neill's books are completely homogenous with mine. there's nothing is going to we're not going to contradict each other on anything. They work together perfectly. And if there's any other book that you should read than mine, it would be all the O'Neill books, because they're incredible. They're Bibles. I don't think you need to go any further than my books and O'Neill's books. So if you want to look a little bit more about the tightness, the weeks tight and so forth, and get some additional color on looking at bases and so forth. O'Neill always used weekly charts. Again, David will be here very shortly, probably within just a couple minutes, and we can ask him a lot of these questions, because of course he worked side by side with O'Neill for decades, and so O'Neill used weekly charts. So also, here's the main thing. All right, I forgot to give you the main answer here. The main thing that I'm looking for on a weekly, and David too, is we look for what we call volume markers. And we're looking for a dearth of negative volume. If we're buying a stock out of a base, we want to see if there's a selling vacuum, particularly on the left side. You can see a lot of selling. That's where you're going to see the selling. That's where the stock sells off. That's fine. When you start getting around the lows and you start coming up the right side, we want to see if there's much volume in there, because that's where we can really see the institutional footprints, how the closes are, how the weekly closes are relative to the volume. And you can see here, there's a lot of good closes. Here's a good close, good close, good close, good close, good close, good close. Lots of good closes. There's only one, I don't know, maybe 2 or 3 bad closes in this whole base. And we come down here, there's no volume above average whatsoever. There's no real spike. You don't see any spike in volume. So I'm looking at these bad closes, and I'm looking at the volume. This is what I want to see. I want to see a dearth of negative volume. I don't want to see a lot of selling in the base, except on the left side. We could look at different, if you look at different stocks, you're going to see different, you'll see maybe a different picture here. I don't really have examples set up for this right now, but that's the basic thing that I'm looking for.
Good. How are you able to distinguish between a stock that's in an extended stage 2 consolidation versus now entering stage 3?
Right.
Essentially, how do you determine that transition?
We're going to get into that during the selling section. We're going to talk about counting bases. We're going to talk about PE expansion. One of the few ways that I'll use a PE, although I have to say that very rarely do I ever use the PE expansion. Only if it happens to, a stock makes a big move, and I might take a look at how much the PE expanded. We're going to talk about this later. I'm not going to answer it right now, that PE expansion. But my point is that the main thing that I'm looking for is I'm counting bases and looking at the price action to see, if there was a climax move and you had a run up of 40, 50% in a couple of weeks, and it's come off of the 4th or 5th stage base. That's a late move. That's very late in the move. If you've accelerated outside the upper channels, you've been moving up at a certain rate, and then you accelerate that rate of advance, and then you form a base, a late stage base after you've accelerated. That is definitely a more failure prone base. So the main thing that I do is I count the bases. And now that doesn't mean that a late stage base, you don't play a late stage base, because I shouldn't say very often, but at times you can get blow-offs from the later stage bases where the momentum's really strong and you can get a really big, fast move. The problem is that they also come crashing down very fast from those late stage extensions. So you just got to go into more of a trading mode when you get into the later stage bases. So that I'm just sort of grading the trend and saying, okay, how early are we here? Now, you don't want to be too early also. You've come off that first stage 1, you just get into a stage 2, you may not have the momentum yet. See, the key to trading and making big returns is to constantly look where, and this is something that Ed Seykota said, I believe it was Ed Seykota, you want to trade where momentum is the strongest. It's not important to get the low or get the high. What's important is to get that meaty part where you're getting a fast move and the momentum is strong, because that's where you're gonna compound, and time, like I said, is money. And also where momentum is strongest, it also is hard for the stock, even when it comes back in, it'll rebound very fast because you've got that upside momentum. When the trend is very strong. So finding that section within the trend is what's most important.
Question on the trend template, which is the scenario basically from last spring with the COVID sell-off and the snapback, that V-shaped bottom that caused a lot of stocks to not have the 150-day below the 200-day. So, do you have wiggle room, or are there times where you can, use some wiggle room for the strictest of the trend template non-negotiables?
Well, I mean, you can use whatever you want. If you want to look, there's no sense in having rules and a strategy if you're not going to follow them. So the answer is no, not really. I mean, like I said, there's a few times, and if you go, if you remember and go back to your notes from the section that we talked about the trend, with very large bases, you may have where the 200-day doesn't get into an uptrend, for very long, and you're coming out of a base because it's a very large. A lot of times with big double bottoms, when you have a dip in the right side, it'll cause and it's a big base, and you have a big dip in the right side, it'll cause the long-term moving average to stay flat or even maybe trend down a little bit. So that's a caveat. There's a few caveats. It was an early turn we talked about, but generally speaking, I mean, 98% of every trade I've ever made, which is tens of thousands of trades, if not probably hundreds of thousands, but certainly tens of thousands of trades, has been in a confirmed stage 2 uptrend, with the notwithstanding the power plays, which the power plays, many of them can not be in the stage 2 uptrend. I don't require them because they're very explosive, and they don't give, from a period of dormancy, they don't give the 200-day and the criteria enough time to turn up. So power plays are the only real exception. Otherwise, you're better off just waiting for all that criteria to be met.
All right. Roy's asking if the VCP setup works on all time frames, and is there one time frame that you have found it to be that it works best in?
On all time frames, yes, it will work on all time frames. And is there a time frame? No, I can't say there's a time frame that it works better on. Nope, it's going to work on all time frames, from intraday charts all the way up to weekly charts.
And what part of the market cycle is best for finding VCP characteristics? Is there a sweet spot of the market cycle for trading your strategy?
No, I mean, you're going to trade them. See, again, I don't like that mode of thinking. All right. How you're thinking, you have to reverse that. Right. That's going to get you into trouble. You're trying to go back. You're going backwards. Right. And that's not allowing, you're trying to come up with a predetermined template to fit into when you should be doing the exact opposite. And what you want to, the way you want to approach this is that whenever they set up, you buy them, and you have no prejudiced or predetermined idea like that. So but the answer is, I mean, your best opportunities are going to come from a correction. A market correction is where you're going to generally get your best opportunities, because when we go back and we look at the data, 96% of big winners start from a market correction. So that just makes sense. Obviously, when there's a bear market, stocks go down and they get depressed in price. And even stocks that don't go down much and just move sideways that are doing well, their earnings continue to come in. The value of the company increases without the price increasing. So the opportune time, for big moves is coming out of a bear market. However, I mean, you might be in the late stages. I've had where, I had years where I didn't do well, and for a number of months and quarters where the market was, doing well off the lows. And then later on, when the market was toppy and not really moving up much and basically moving sideways, stocks took off, from the type of setups that I look for. And I was up 50, 100% in just a couple months. So, again, you gotta let the stocks lead you. Forget about the market, forget about the groups, forget about the economy, shut the TV off, shut all the newsletters off, and Learn how to spot the stocks setting up according to the criteria that we're laying out. Buy them when they start breaking out. If they're working, get more aggressive. If they're not, pull back. If you can learn to do that, and it sounds easy, it is very straightforward and very simple, but it's not easy. As a matter of fact, the more simplified you get, the more you have to be really so good at what you're doing. That's the whole idea. But the more simplified you get, it actually becomes more difficult in the beginning, because you've got all these things that are always giving you some type of rationalization to make a particular move, when you've got to take all the noise and get rid of it and focus on what works. And that's, if you're trading stocks, look at the stocks.
Question about if a stock sets up with a smaller than normal stop, for example, 2% versus 5%, do you adjust your position size to risk the same amount of dollars that you would normally risk versus percentage in that case?
Well, in the case that you're saying, if it's set up with a smaller stop, I risk more. But I'm not adjusting my position size necessarily for stop. Like some people say, well, if I'm buying 1,000 shares with a 5% stop, then I can buy. If I take a larger stop, then I'll just take my position down. See, that's really not what I want to do, because that nets out basically the same thing, right? So what I'm trying to do is get what's called asymmetric leverage, or asymmetric. I'm trying to take advantage of asymmetric volatility. So what that means is that I'm cutting off the downside while putting myself in a position where the volatility on the upside, the other side of the volatility equation, I'm exposed to. So I want the smallest stop with the biggest reward. So what I'm trying to do is get into the tightest stop with the largest position. Now, I will take if there's a tighter stop and maybe it's a more liquid name, yes, I can take more risk now. I can take a bigger position, and I might take a smaller position with a larger stop with more risk, maybe more liquidity risk or spread risk. But I'm not automatically just saying, okay, well, I can take a 10% stop here. I'm going to go into this trade, and I'll just position size smaller. That's not my default thinking. I'm trying to get into the tightest stop possible, and always back into that. And yeah, if you can get into a tighter trade, you can position size larger.
All right. There are some questions regarding, Mark, your screening process, your daily routine. Just to let everybody know, we will be going through all those questions during the live trading day on Monday, November 22nd. You're going to see Mark's the whole process, from his pre-market routine, screening, how he handles the opening bell, trades that we can find to take. So all that will be answered on Monday. How do you filter down, though, when you're screening, the question of the hundreds of stocks that the individuals finding a Market Smith to a manageable number that can be traded? Again, this may be something we defer to Monday.
Yeah, well, we're going to go over screening, and we're going to look at how I filter things down and how David filters things down, and Mark Ritchie's going to be there as well. And you'll see, that it's a lot more straightforward than you might think. But again, we're going to go over all that, and it'd be better to talk about it when we have examples and we can actually show you on the screen, exactly how we're screening in Market Smith, and show you how we're laying it out on our, or at least on my desktop. I'm going to show you how I lay it out on my trading desktop. So you'll see exactly how I do it.
Okay. And a similar question to that, what other tools, software programs do you use or recommend for us to use?
I'm just using quotes. I use eSignal, which has a nice way to be able to keep your portfolio and your watch list and tie it in with your charts. And then when you just click on one symbol, everything updates. All the charts. If you've got 20 charts, they all update. That's a lot of software does that now. You certainly can use the software on your brokerage firm. Like if you're using a TradeStation or whatever, Schwab, everybody has charting software, but I use a separate, I use eSignal. It's a separate paid piece of software. I like eSignal. I was using Q charts for many years, and eSignal bought Q charts. And screwed it all up. Unfortunately, Q Charts was a better program in my opinion, but I think eSignal is the next best thing. And then I'm just using I just have my my order entry on a separate screen. That's really it. And you can have, if you want to, you do some macro stuff, you can get stockcharts.com or something has a lot of those charts that I pull up where if we want to look at interest rates and all those other factors, that's fine. But you should be spending 90% of your time on MarketSmith, have the quotes, a portfolio management spreadsheet, and your order entry, and that's all you need.
All right. Getting notification that David Ryan is in the house.
Hey,
there he is. Hey, Dave.
Good morning.
How's it going?
Good.
You look very vibrant today and happy. Did it go good on IVD Live?
Yes, it did. It was good. I went over my biggest losses for the year and my biggest gains for the year. So it was it was painful, but then I was able to go on the ones that I had done well on. So it was a good. I guess it helped everybody learn that we are not infallible, that we make mistakes, and
absolutely,
and it's just trying to keep those mistakes small that's so important.
Right. So did you suffer any big losses this year?
No, there were a few that a new issue figs that I had actually a 17% loss on because I bought it on a pullback and then it kept on pulling back. So, and then I rationalized and, I again, on human like everybody else. I had one. I also had
FIGS is not coming up. Is that the reason why?
I don't know. That's that was the that was the.
There. I know it's coming up for me.
Let's try it again.
Yeah, you don't have to bring it up.
There it is. There it is. I figured. Yeah, I figured we rub a little salt in here.
Yeah.
I got you.
Yeah, if you want to see where I bought it on a pullback, is February 23rd.
February 23rd. Meaning,
go back there.
Wait, where are we here?
Wait, February. No, I'm sorry. No, 7/12. 7/12. That's 7/12. July 7/12. There.
So you're trying to come back here.
Yeah, pulling back to that 21-day moving average.
And you immediately got clobbered.
Right. And then I actually didn't sell
rationalization kicked in.
Yeah, I didn't, because I thought, this, great concept. We're in the middle of a healthcare crisis. Everybody needs these, on and on and on. And I didn't.
This is what happens when you're really smart. This is what happens. See, even the great David Ryan isn't immune.
And so, this is why you have to be disciplined and sell. I mean, if I was buying off that 21-day moving average, then I should have sold on the break of that 20-day. It wasn't a big position, and maybe that's why I rationalized it. But I didn't sell it until August, right there, almost like August on the low, August 4th, 8.4.
8.4. Well, that's over here. That's.
Oh yeah, right there. Yeah, there. Couldn't take it.
Oh yeah, there you go. Yeah,
bottom
tick down here.
Yeah, but even so, I mean, it was actually. I mean, if you want to, I should have sold it. Your first sell is always your best sell, but I sold it late. But even then, it's been good because the stock hasn't gone anywhere since then, and it's best to move on when you admit a mistake and go on to the next one.
You see, guys, how right when the market knew David sold is when it started going up?
Exactly.
It watches all of us. The market watches all of us.
That's mission control, man. You wait and it's okay. All right, he's gone. Pull the switch.
Let's go.
Yeah. It's uncanny sometimes. So all right, that was interesting. That must have been very interesting for everyone.
So,
so and then I went through some winners that I've had that I still have. Revolve, I bought all the way back in December.
Yeah, I love Revolve. My wife loves this company. She shops. This is like one of her main places that she shops.
Yeah, it's only.
We just bought it over here and still holding it, holding a piece of it right now.
Yeah, this is one all the way back of last year, 12/8 of last year.
12/8. So that's really
look at that right there. You see it coming out of that nice.
Yep. So you're coming up. So okay, all right. Now you're giving us some textbook. I was getting worried about you there for a second.
Yeah.
All right. So 12/8. You're over here. So you waited. You gave it a little confirmation. Let me get a little line to draw here so we can see what we're looking at. Hold on a second. Where is it? 12/8. Oh, hold on. Oh man, this Zoom thing gets in my way and drives me crazy. Let's see, 12/8. Yeah, so right here. So you gave it a little bit, it came out and then you got it the next day as it sort of followed through.
Yeah. Yeah, and then it pulled back for a couple of days, but that was fine, light volume.
Yep.
And then added to the position. But nice longer base. And you see how this is how, even from the bottom, this is how a stock should act. It moves up quickly and then it drifts down to the right. And it moves up quickly and down to the right, up. And that's the natural order of a stock in an uptrend.
And Dave, this just is really, it's picture perfect. You've got the first little reaction, right? And then look, boom, tennis ball action.
Yeah.
Then you run up. Let's just apply this in our analysis that we talked about with the confirmation and violations to Dave's trade right here. So he buys here, a couple days comes in, that's fine, that's perfectly normal. Now you have to look and see, is this going to snap back here? You got 3 lower lows, right? 1, 2, 3, support on the third, coming back to the breakout. That's perfectly fine, but it's game time. This is where the rubber meets the road. Now you got to watch it carefully. If you get another lower low, comes in, can't rally, okay, we got some violations now, and we got to start watching it carefully. But no, right back, tennis ball action comes ripping back. Now we count the days. Here's where it actually broke out. It actually broke out on the 7th. So we'll start from the 7th. 1, 2, 3, 4, 5, 6, 7, 8, 9. You got 10 out of 12 days up. 10 out of 12 days. So your first couple weeks looks great. So like I said, that's where you should try to go through a pullback. Here's your first pullback. Natural reaction, right back to new high ground. Tennis ball action, right? Still acting fine. Now, as you get, as I pointed out, once you get a couple natural reactions, you've got 1, 2, 3, maybe even can call this 4. Let's call this 4 or 5. When you start getting to after your third natural reaction, your fourth, fifth, what usually is required, right, is to undercut a previous low. I think, did we already cover this? If we hadn't covered this, we're going to cover this, but I'm pretty sure we did. So you're going to undercut that previous low, and that creates that shakeout. This might have been to earnings. I don't know. You know better than me, Dave. But again, still moving here. And now as you get later, you see there's more volatility. See now, because now there's more eyes on it. The stock's made a gain. There's profit takers. It's not as efficient now, and then you're getting that volatility, and you need sometimes a correction and to reconsolidate. Now you've consolidated again. Now let's go back to the beginning here, right? We're going all the way back. When was this? This is your IPO here.
Yeah.
And so, like many of these, they start off as an IPO and they fail. This off the highs. This came off almost 70%, right? Something like that.
Yeah, well, that was also going through COVID too, that dropped so many stocks.
Right. But now it turns into the stage 2 uptrend. So basically, David bought this. This looks like this might have came up on the 1-month trend template. This is like right just as it turned into a stage 2 uptrend. You got your first base going into a stage 2 uptrend. Now, now you're in a confirmed stage 2 uptrend. I'm buying it over here. I'm buying coming out of this base. So this is after it's in a confirmed stage 2 uptrend, and it's acting fairly good. And I'm applying the same analysis, right? We bought it on, hold on, let me move my Zoom bar again because it's blocking everything. Let's see the exact date. We bought on 10/29, right? Which is right here. Let's see. Oops, sorry. How did that just, oh boy, what did I just do? Hold on a second. How do we get rid of this now? I have no idea how I just did this. Just screwed my charts up. Sorry about that. Hold on, guys. I moved the moving averages down off my chart. How I did that, I have no clue. I have no idea.
Is it worth closing? Closing, don't save it.
Close
it, don't save it, and reopen it.
Yeah, that's crazy. Hold on a second. Let me see if I get rid of that. Okay, so now I'm gonna have to put my moving averages back. That's really nuts what I just did. I have no idea. I did one click and made all this damage. So let's take a look here. So coming out right here, right? I'm gonna just
1029.
Draw a line from the pivot back. And you can see not much overhead supply. You're going into new high ground here. So you get that first day you squat, right? And my stop was set below the low of this pivot. And it just came down and it didn't take it out. And you got a good close. And then the very next day came back and you got a 1, 2, 3, 3 or 4 day reversal recovery. So again, I'm going to apply the same analysis here. 1, 2, 3, 4, 5, 6, 7, 8, 9, so 10. We're looking at 1, 2, 3, maybe 4. So we got 6 out of 10 days up, something like that. Acting fine. Still, this is looking really good in a tough environment right now. So anyway, while you're doing the next question, I'm going to try to get my moving averages back on here.
All right.
Let's see. Go ahead.
So one question asking from Margaret Smith: is there a list for relative strength new high stocks? Is there
I don't know if there's a set list. There's actually on mine. I actually have a screen that. I have a screen that shows new highs. So you can either screen for it, or there might be one set. I'm not actually sure. You can actually, if you're a Market Smith subscriber, you can call them or write them.
Maybe we'll get Arusha to answer that on Monday then.
Yeah.
Question: even though you trade stocks, Mark, you have made some amazing market calls at major tops. How do you know how to time the market so well if you're just trading your stocks?
How do I know how to time the market so well? Well, I mean, there's times where I do time it well, but I'm always timing the market. If you want to call it market timing, I'm not market timing ever. I'm simply following the individual stocks, and when there's stocks setting up, I'm bullish on the market. When there's stocks not setting up or failing in particular, I'm bearish on the market. Obviously, I've been doing this for almost 4 decades, so I have a pretty good ticker sense and feel for what that means. What the stocks are doing, how to equate that to the health of the market. Doesn't always line up with with the Dow topping or bottoming, but I can tell you right now that you're gonna be on track a lot more by following the stocks than you are going to be by trying to predict the market and reading the tea leaves and looking at the Dow and all that. I just when there's lots of stocks setting up now, also the market could be acting great, but there's a lot of stocks that are extended, and you've got a lot of hyper-extended stocks. Well, that automatically tells me that, we're probably in for a pullback. And not that it's going to be pinpoint accuracy, but definitely, I know when the market's getting much more risky and I should be starting to nail down profits and backstop my gains. Dave, how about you as far as, we're certainly looking for follow-through days and distribution days, but that's really secondary to the individual stocks, right?
Yeah. I get a lot of feel for the market by just looking in what my individual stocks are doing and going through hundreds and hundreds of stocks each week. And the general market can really sometimes shake you out of some great stocks. When the market looks bad and it looks like it's rolling over, you go, well, I got to sell something. But you really take it down to each individual stock and how those are doing is the way I get, probably 90% of my feel for for what the general market, those indexes are doing. And there's sometimes where the general market averages can just be going sideways, and you have some stocks that are doing extremely well. So I'd be careful to have the indexes influence your individual stock selection too much.
Funny how David just said exactly what I said to you before. I said about how the indexes could be going sideways and stocks are rip roaring, and the same. He wasn't even here, but we're like I said, we're doing the same thing. It's not. There's no secrets here. It's just getting good at. Is there a secret to hitting a baseball? Some people hit a baseball better than others, and it's from hard work and practice and. But the basics, the basic fundamentals are what you have to get good at. And it's the same thing with this, concentrate on getting really great at what we're showing you here, and you'll be astonishing your friends and yourself, and you'll be in the market when it's doing great and out when it's not doing great, and be calling those bottoms and tops like you've got some crystal ball at times.
Follow up to that though with David, since you do more longer term investing versus Mark's shorter term swing trading, do you, when a market condition deteriorates, do you hold through that with your longer term objectives, or do you just cut everything across the board and then just get back in once the coast is clear, so to speak?
It depends on the individual stock, and I take them one by one. But if I really feel the market's going to correct and take everything down, then I will reduce some of the positions that I really like longer term. I'll reduce them, or I'll sell some calls against the position, or I'll even hedge in the market to offset the drawdown in some of the stocks that I want to hold through a correction.
But you're not holding a stock through a correction if that's not acting right?
No. I mean, if it's really breaking down, then I will sell the stock out and then come back to it. If it's something, and this is, if you go the longer term you go, the more you have to know the fundamentals of the stock, because if you're going to hold something for even a year or 2 years, at some point along the way, I mean, even if you look at Revolve, at some point along the way, that thing's going to look horrible. It's going to look like it's breaking down and it's going through moving averages and things, but that's where you have to rely a lot more on the fundamentals. But if you're going to be swing trading, then you can be in and out of that and avoid some of those big drops. It all depends on what you're comfortable with and what your time frame is, and how well you can get to know a company. So I combine, if I want to hold something like Revolve, I've held it since last December. I still own it. But there are times where it's a very small position when it is not looking good, but it's enough to keep me focused on what the stock is doing, even during a tough correction.
Right, but let's make one thing perfectly clear, and this is the thing that scares me about when I start hearing some of these questions, that it's sort of, a lot of people start rationalizing, and they say, "Oh, well, I'm a long-term investor, and the David Ryan said the fundamentals are good. I'm down 20% on the stock. I'll stick with it." Dave, make sure we clarify that you're holding Revolve because you're at a profit.
Yes.
If he's at a loss, he's stopped out of the stock. It doesn't mean, he's not saying that, the fundamentals are good, so it goes down 10%, hits my stop, and I'm going to hold the stock. He's talking about holding at a gain and trying to play it for a larger move.
Yeah, and see, the stock's trading at 85. I still have stock that I bought at 27. And so I can go through, larger corrections because I have such a cushion. But even with that, if I have a big position in a stock that I really like and it's starting to correct or it's breaking moving averages, I'm not going to sit there with my full position and just ride through a correction, and because you never know how big it's going to be. So I reduce the position, or I hedge against the position. Just because I like the story over the longer term.
Dave, Bob, let's get to some more questions because we got off questions. Yeah.
How do you, Dave, and also real quick, you may just need to either lower your volume or your mic is a little close to your mouth.
Okay.
How do you avoid buying that first breakout failure mark and then be able to buy on the failure reset?
You got to go to a local pawn shop and buy a crystal ball. And once in a while, you can find one on sale. There's you don't. We only have the information that we have at the time, right? So when you look in hindsight, and that's the difficult part. To get good at this, now we go back, right? Let's go back here and take a look. Dave's buying this right over here, coming out here. And he doesn't have any other information than that information at the time. All right. So you have to get good at being able to decipher, when you have a quality base and a breakout, before you have that hindsight information. You go back, you look at a chart and you go, oh yeah, this is the spot to buy. Yes, but we have to make that decision over here. Right. So let's just say, you're buying this stock and it comes down, it takes out the low and the pivot, it acts, squirrely and stops you out, but then maybe tightens up and resets and then breaks out. Well, we can only get the information that we have at the time, just like, with a low cheat, you're starting in that low cheat. That's what you see. You don't see the cheat. The cheat hasn't developed yet. It may never develop. The handle hasn't developed. It may never develop. So that's why we try the cheat. Sometimes we then get a handle after a cheat, or we buy the low cheat and then we get a cheat and a handle. Sometimes we get neither. They just run right off the lows and they're straight into new high ground and we can't buy them. So the answer is, we don't know whether it's going to fail or not. That's why we use stops. And that's why we have techniques for buying back in and having a reentry mechanism.
Failure is part of the process, guys.
Failure is part of the process.
Don't be afraid of losses. If you're doing it right, your losses will be half of what your wins are, and that's how you make the money.
Don't be afraid of small losses. You should be afraid of, getting losses over and over and over again. And that's, of course, if you're getting stopped out multiple times, you certainly got to pull back your exposure. But be very afraid of large losses. Be very afraid of large losses. Large losses will wipe you out just like that.
Mark, you mentioned you track the percentage of stocks above their 50-day or 200-day moving averages within the NYSE or the NASDAQ. Where do you actually source that data from?
You can get that data from stockcharts.com. And they have a lot of charts in there, lots of things that you can get from stockcharts.com.
Is the average true range or ATR indicator meaningful to you? Is it effective in tracking the volatility of a stock?
I think ATR is one of the most dangerous things that you could possibly use. It's very misleading, and it's the exact opposite of what I do. What I'm trying to do is, and this is something that Larry Hite, that I learned from guys like Larry Hite, and some of even the futures traders. And you'll hear Larry Hite talk about asymmetric leverage. I call it asymmetric volatility. He calls it asymmetric leverage. We're talking about the exact same thing. What we're trying to do is cut off the downside volatility and expose ourselves to the upside volatility. And we want that downside. We want to skew that curve, right? So what ATR does is the exact opposite. It adjusts for the volatility and allows more room on the downside, which to me is moronic. All right. It completely defies the whole idea of the opportunity that you have. People who don't like to take losses love ATR. They love ATR, and ATR can work for an extended period of time. And then when it doesn't, you blow up. I'm an ATR. I have to say I'm an ATR hater. That's how much I dislike ATR.
I never look at it. I just look at the volatility of I'd look at the chart, and that tells me how much volatility there is. And if the stock changes characteristics in terms of volatility, then it's usually at the end of a move, and that's where I start reducing my position. But I never look at ATR.
One thing that William O'Neill convinced me of, and that was that everything is in the chart. You can keep it very simple. It's all in that chart. all indicators, all right, keep this in mind, all right? Think about this for a second. An indicator can only be coincident or lagging because it's based on the thing itself, right? It's based on the chart. So if you have an indicator that is based on, MACD, stochastics, whatever you want, whatever you want to call it, even volume indicators, they're calculating from the price and volume. So they can only be coincident or lagging. They can't lead. It's impossible. You can have divergences and you can have those type of things, but the bottom line is that the information can only be coincident or lagging. So why not just look at the thing itself? Why not just get good at looking at the source? And that's something that O'Neill convinced me that you didn't need anything more than that. It's probably one of the best lessons I ever learned, because that's what really made me become an expert and really great at just reading bar charts. All the information you need is right there. You don't need anything else. But we try to come up with these tea leaves and these indicators, like it's going to magically give us these buy signals and sell signals, when in fact the buy signals and the sell signals are right within the chart, but you just don't know how to read it yet. So get good at reading the chart, and you won't need it. I can tell you when a stock's overbought. I can tell you, 90% of the time I can tell you the readings of these indicators just by looking at the stock chart and never even looking at the indicator itself.
Do you, Mark or David, use buy stop orders, buy stop limit orders, or just market orders? Or do you just set alerts on your screens notifying you when to buy?
I set alerts on my screen. So when it starts hitting the price, then I just start buying. And I usually, depends how much I have to buy. If I'm buying a really big block of shares, I parse it out into smaller pieces. And it depends on the liquidity of the stock. I mean, if it's GM, I can go in and buy 20,000 shares at the market and get executed within a penny or two, probably. So it depends on that. But very rarely am I putting orders where they're stops with the broker. How about you, Dave?
It's sometimes I do, because I either have something else to do, or I'm reading something and I can't keep an eye on the market, or I have to step out or something. Then I will put a buy stop or a sell stop, but it's usually just for the day. It's not a good till canceled. It's just for when I'm out of when I'm away from my screens, that I do that.
Yeah, that means I just want to decipher that. That means playing tennis, surfing.
Okay. No, I don't do those while the market is open.
I know.
The good thing is on the West Coast time, the market closes at 1:00, so I'm free to do things in the afternoon.
Working in the orchard.
Yeah.
Working in the orchard.
On a similar note, are you buying 1 penny above your entry point, or how much are you watching volume at the time of entry?
That's a good question. We get that question all the time. If the stock is trading out of the base and breaking out at 9:48 in the morning, you're not going to have much volume. So, and even to extrapolate, you could extrapolate the volume. You could say, well, how much volume do I have here in the first half hour? And then times that by how many periods there are in the day. And you can get an idea of where you might be at the end of the day. So now if you're at the end of the day, you can get a much better idea of the volume and what it's going to be. So I'm not looking at the volume as far as the total of the volume early in the day. I'm just looking to see if volume's coming in while it's getting through, while it's starting to move, and look at the offer and how they're hitting the offers. But I wouldn't get too crazy into that. I'm not even really, that big of a stickler on volume being huge necessarily on the breakout. Sometimes you have a low volume breakout and then it comes in a day or two later. I'm more interested, and to be honest with you, Dave has kind of shifted me more from getting too myopic on that first day breakout and looking for volume and saying, okay, it has to have this and more looking at those subsequent days. This is something that over time in us working together, and we used to talk actually quite a bit on a daily basis about stocks. I started moving more towards looking at the subsequent days and counting the days and looking for the confirmation, seeing how many days good closes and if there's how many days have been up versus down. So I'm really just watching the stock, see how it acts around that breakout. But you want to see a big breakout on big volume is great. I mean, that's great. And if it follows through a couple more days, that's even better. But it doesn't necessarily mean that if it doesn't happen that way, then I'm going to just sell the stock. But you're not going to be able to know. I mean, Dave, you're buying a stock at 9:45 in the morning, or in your case, maybe a little bit later. I know you like to wait and let the market trade a little bit in the morning, but very early in the day, what are you doing to get a read for the volume?
Yeah, well, if I do look at this, see if the volume is picking up, but if the stock setup, if it's gone, very, very tight and it's starting to move out of there and everything else is good, I'll go ahead and buy it regardless of thinking that the volume is running up 100 and 200%. I'll at least start the position because sometimes it is strange that the stock doesn't get volume on the breakout, but then the next day everybody recognizes it and then it starts going. So you don't have to get super hung up. Yes, the bigger the volume, the better. Because that just shows you institutional buying, and you want to see that somewhere in those first few days of the stock breaking out. If it doesn't get it, then you just have to. Then it's probably thousands of alarms going off on people's screens and individuals just buying it, but just not getting in any institutional support. That's what you have to be careful of. But
Revolve, Dave, is a perfect example where you break out here, and this is the day, of course, where you came out where you came out of this base. You come out and the volume is up a little bit, right? It's a little above average, but nothing to write home about. But it closes right near the low. So this is not a breakout, not a good breakout. It tries to break out and it fails, and then the next day comes in a bit. So if you're really short-term oriented, you probably would have been knocked out of this. But at this point, you just stick with your stop. You should have already made the decision as how much you were going to risk and whether there's a technical point which it crosses and that you're out. It should make mathematical sense, of course, or there's just a dollar amount. But now take a look here the next day here. It has a pretty good day, and see the volume comes in and it's higher than the breakout volume. And then the next day you're up again. You come all the way back down, but you get a good close and the volume's up even more. And then this day you move even higher. You get 3 days in a row, and that volume is even higher than the breakout volume. So now you got those 3 days where it recovered and the volume's coming in. This is what I'm saying about looking at those subsequent days and giving it a chance. You got to give stocks a little bit of room to fluctuate. All right. If you choke them off too much, you're just going to be getting stopped out all the time. Some people take this to an extreme and they think that, the second the stock goes down, they've got to get out. Okay, you can do that, but you're going to be trading a lot, and you've got to make up for that in some way. But looking at this stock, it didn't do anything wrong here, and then it started coming in. So that would be now if the opposite. Remember, the violation that I talked about was low volume out, high volume in. That doesn't necessarily mean that the volume coming out is necessarily low, below average, but it's lower than the volume coming back into the base and undercutting the pivot. So let's just say that this volume came in on the downside now, and you tried to rally, but then you came under and you start undercutting these lows, and you got below the 20 and the 50, and now the volume's coming in. Now it would be the opposite scenario where you've got low volume out, high volume in, and I'd be looking to cut back on it or sell it if it hadn't hit my stop yet. But again, that's why those violations and confirmations, I think that might be the greatest contribution that I've made for traders in writing a book, and I think that's a really, really valuable thing that up until David and I start talking about this, I've never heard anybody look at stocks this way post breakout.
The next question is a classic that we get every year. How do you handle if you have several names on your watch list that are all breaking out at the same time? How do you handle entry of multiple names, and how do you know which ones to buy?
Okay. Well, again, that's usually question comes from somebody who hasn't been trading very long, because we all know, if we've been trading for a number of years, that all the stocks breaking out at exactly the same time virtually never happens ever. I mean, I don't think it's ever happened in my entire career where, I got 10 stocks on my list and they're all breaking out. Could a couple, and could they come fairly close to each other? Sure. I've had where, two or three names emerge, really close to each other. The answer is that I buy in the order of breakout. I'm almost always getting that first mover advantage and then buying whatever moves first. Now, the key to that, though, is that it would have to be where, let's just say you have 4 names you're considering. All 4 of those names would have to be set up correctly and have buy points where they are in buyable position. All right. And then from there, now whatever stock breaks out first, that's the stock that I'm generally going to go in, and let the stock, pick me. I say I don't pick stocks; they pick me. They at least they pick me as far as the buy points are concerned, when to buy them. Prior to that, I'm running the screens. I have to select the names that I'm interested in based on certain criteria. Once I get that and I've met all that criteria, and now we've got that buy point, that pivot buy point is set up, that's the price. I say, okay, at this price, that's the price that I should enter. And I've got 4 names that all have buy points and stops. Now I want to let the stock select me. Which stock moves is the one that I'm going to select. How about you, Dave?
Yeah, it's rare where you have, I don't know if I've ever had 10 stocks breaking out on the same day, but
or even 3 or 4.
Yeah, I mean, if there's a 3, then I'll go ahead and buy all 3. But then I let the market determines which ones I add on to and which ones turn into bigger positions just based on their price performance. So it's sometimes when the market, especially when the market has gone through a bear market and you're just starting to turn, I might have a lot of smaller positions and just let the market show me which one should I be adding to, which one is going to be the leader, because sometimes you don't know at the beginning of a turn or even at the beginning of a breakout. So it's almost like a numbers game. Maybe you buy 3 on that one day and one of them turns out to be the great big winner that you can really do well off of. So, if 3 are going, I'm going to go with 3, but it's rare that you get that many all on the same day, because lots of times when a bull market is about to start, your best stocks are actually breaking out before the market follows through. And it's happened where they can be breaking out months before the market turns. So it is very, very rare that it all happens all at the same time.
Yeah, and let me point out a little subtlety here that that you'll notice once I illuminate it. When you hear Dave, a lot of times you hear him talking about adding on and building positions. The reason why that Dave is in that mindset is because Dave was managing a hedge fund for a lot of years. 15 years, right, Dave?
Yeah.
15 years managed a hedge fund. And prior to that, he was managing a mutual fund with O'Neill, the New USA Fund. He's buying huge blocks of shares where he can't just go in there like you can, okay, and just buy it at one price. It just doesn't work that way. When you're managing big money, you become by default incremental. You have no choice. You have to be incremental. This is why we show you how these stocks will break out for a number of days, and that we can ascertain that that's institutional buying versus retail buying, because institutions, if it truly is an institutional breakout, they're going to be building that position. They're on a pullback, even a pullback, couple of days, they'll start coming in there and supporting that stock after a few days pullback, and it's going to take them some days. And if the stock's really a hot name that has great earnings and really has a lot of promise, there's going to be lots of institutions in there, and that's how you get these big volume breakouts. And then for a number of days and days and days keep going, because you've got that big volume coming in there. So I'm coming from it. I had managed some hedge funds in the past, but most of my entire career has been, and I've made virtually all my money just trading my own personal account. I'm relatively small, compared to even I take positions, $8 million, $10 million. I take in a position even to this day, but that is microscopic compared to a hedge fund or a mutual fund in particular. Dave, this was a while back, of course, when it was even more money than it would be now, but Dave was managing, $80-100 million. So again, that's not something that you just slip in there undetected. If you're buying 500 shares, 1,000 shares, you have this technical superiority. You don't need as much information about the company because you can move so quickly. And with a mutual fund, they need to be rock solid sure that what they're buying has got some legs under that table, because if it turns tail on them, they're in big trouble. They can't just get out of the stock. They can't cut their loss. That's your advantage. Your advantage is that you can cut that loss right away. And that's why you got to make sure you take advantage of, you use that advantage.
Today, Dave's an institution individually himself, I guess.
What's that? Dave's an institution?
No. When I was running the mutual fund, we averaged somewhere around $180 million under management. So it would take days sometimes to buy positions, and that's when things weren't as liquid as they are today. Stocks seem to be trading a lot more than they did back in the early 90s.
And relatively speaking, $180 million is microscopic.
Yeah.
You have one hedge fund that'll be $8 billion. You have a mutual fund. These mutual fund families, they have hundreds of billions of dollars under management, and one fund could be billions of dollars. So just imagine the position size that they have to take. This is that slow moving process is why this is the power of what we're showing you, is that you're able to be armed with the exact same tools and the same information as the manager of Fidelity Contra Fund, except you can move at lightning speed and take advantage of it. I mean, you have such a huge advantage. It's unbelievable. An individual investor, once you learn this properly, there shouldn't be a year that you don't beat the S&P 500 ever.
And that actually ties into what is literally the next question of at what point do you add to a winning trade? So with David having to build positions, but Mark, how would you add, or when is the time to add using SEPA?
So, all right. So Dave, Dave might give you a little bit different color on this. I only add to trades on pivots within the base or a pullback to the breakout. So I don't ever want to buy a stock that's not coming out of a base, or maybe, like I said, it breaks out and it pulls back to the base. So I'm still essentially buying it right at the breakout of the base into new highs, and that's why I like to use the low cheat, the cheat, and the handle, because I can actually build into a position. If I had to build a big position, I can build into the position. And sometimes I get those multiple entry points and I get a lower average cost than I would breaking out to a high. But I'm building in, it has to set up where that next buy would be my first buy. Like, it would be okay to buy it for my first buy. Every additional buy that I make has to stand on its own merit, that it's a good buy at that point, not just because it's a pyramid, but it would be a good initial buy. So I'm only buying, based on whether they're setting up multiple pivot points, and they're almost never ever buying at a lower price. If I buy it, at $100 and now it pulls back, unless I'm building a position, and I might buy if it's a little bit lower and I'm building a position into a pivot point, a pullback buy, but always buying at higher prices too. How about you, Dave?
Yeah, I'm adding to a position, and this is where you can make some very large money. If you get a stock that has all the characteristics, it comes out of a base, you make your initial buy, and let's say you get a nice 10% position bought into a stock. It moves up, and it has a nice move up, and it goes up 25%, builds a whole new base. And a whole new base would be, in my terms, would be at least a five week base, and then it might even have it tightens up in that base and breaks out again. That's where you can add on to onto the position. And the other ways you can also do it is if the stock has a really nice move up, it pulls back and gets support on a 21-day moving average. That's a shorter term, more aggressive. Or it pulls, it pulls back to a 50-day moving average and gets support and starts pulling off that. That's where you can add to the position. It all depends on how long that second base is and how much support you have below. To me, also determines how much you're going to be adding to that position. If the stock goes up and builds a nice, 6-8 week base and then breaks out again, you can almost treat it as a new position and double the position if you have that much conviction on a fundamental basis on what that company's doing. And that's how Bill made a lot of money. Bill O'Neill made a lot of money, is just he would concentrate. He had the ability to take all the thousands of stocks in the market, boil it down to really one stock, and just keep on buying that stock as it went through new bases or came back in on pullbacks.
Yeah, and that's a great point that David just brought up, and something that that I'll also share. That again, if you build that next base, now we may have that situation all over again where you're adding to the position on that next base, and you still have those multiple buy points within the base. Let's say it forms another base, and you get a cheat and a handle. Now you've got those 2 buy points. So I might be buying maybe a couple times within that base and adding, and then maybe David's even, pyramiding up on the breakout to new highs. But once you get out of that base, now, we're not chasing it up. That's the key. I think that's the key takeaway here from both of us, is that we're not chasing the stock up and just buying it just because it's higher. It still has to come out of the base and come from a low risk entry point.
And just to clarify, buy points and pivot points are one and the same as a definition?
Yeah.
Yes, absolutely.
Okay. So this is a point, Mark, where we could take a 5-minute break.
Yeah, let's take 5 minutes and then we'll come back.
And
a little breather here.
I'm gonna just pause.
We've been going for an hour now.
Actually, an hour and a half. Went
you
fast.
You can hit pause record, by the way.
Yeah.
Dave, you're back. Where's Dave?
I'm here.
He is there.
Hey, so we're back recording.
We are back recording for the
good
continuation of the
Q&A. Dave, I just found a couple things. So yeah, obviously you remember these.
Oh yeah.
So this is really sort of where David and I started, was with these books right here.
Get it closer, Mark. Get that closer.
See, this is the daily graph. The daily graph. Here's the little charts, and to some extent, I think Dave, I think you would agree with me that I think we'd almost rather go back to these, huh?
Yeah. Oh yeah. Back to the printed.
Yeah, I would prefer to go back to these books because, first of all, most people aren't willing to do the work that we did with these books. And you could see the 4 charts all at one time. I was actually faster in these books than I am even now with the computers. So there was 2 books. One was the New York Stock Exchange. The other was the NASDAQ and the American Exchange, which now you get all this information on MarketSmith, and it's 10 times better as far as how you can slice and dice information. But I traded almost exclusively, from these charts, even without having charting in the beginning. And this little device right here, I made some of the things you've read about me and the money that I've made in my past was made on this device right here. I still have it to this day. It's called a Quote Trek, and this was before internet, before anything. There was not even no internet, no email, no online trading, none of that. You had to call a broker. And my internet connection, I always show this right here. That was my internet connection. It was a FM
radio.
Yeah. FM radio. Yeah. And it wasn't too accurate either. And I was profitable using this little device. And if you ever saw it turn on, it's hysterical. It's like one of those old like Casio watches where I don't even know what they call it, where it's like broken up little lines and really archaic. So whenever someone tells me that we had it easier, it's beyond hysterical. I mean, this is what I had to work with. So trading is literally 1,000 times easier than ever. It's unbelievable how amazing it is now. It's a great time to be a stock trader. Don't let anybody fool you and convince you that somehow, you can't do what they did before. It was easier. I mean, you go back to Jesse Livermore. He's trading bucket shops and curb brokers and, reading the tape. I mean, it's just gotten progressively easier and easier and easier to make money and to have the access to the information. Back then we had no access to information either. Now you have access to all the information that the pros have. They leveled the playing field. The laws changed, actually. It was one time, pros could have the really good information and you had no access to it. They could share information amongst each other. So anyway, I just thought I always share that and everybody gets a kick out of that.
Yeah, they do. At your fingertips on your cell phone anywhere in the world, you can place a trade today where real-time charts, free quotes, real quotes, you didn't have any of that.
Yeah.
Free pay.
Commission-free trading.
Yeah.
When I was trading with those charts and with that little device, when I first started, commissions were $170 per trade. They were actually, if you were at a full-service broker, they were $350 a trade and upwards. They're actually the brokers used to get rips where they got a percentage of the trade plus you pay this giant commission. When commissions finally came down to $60 a trade, we thought, wow, this is like deep discount. We could actually trade now. And then later on, they came down to $20. And that was just where, that's where you started seeing short-term trading emerge, the SOS bandits and things like that. So it's been an evolution, and the only thing that's changed is things just move faster now and information is more readily available. So anyway, let's get to some more questions. We're gonna keep going here for quite a while. We're gonna go another hour, then we're gonna take another break and try to go even one more hour after that. So there's a lot. We're gonna get to a lot of questions here, hopefully.
One of a very popular question is how many days or what amount of time would you be willing to still buy a stock before its earnings day? And how do you handle holding through earnings is the follow-up. So those two questions a lot of people ask.
Yeah, this is a very popular question, both of those questions. I will sometimes buy the day before earnings, the day of earnings that they're going to come out after the close. And I might buy them that day if the stock's breaking out in the hopes that I get at a profit right away. I mean, sometimes the stock will break out and be up 8 or 10% right on that day. And if I get it just right coming out, I might have a 8% profit, and I can go into earnings with that cushion. I mean, I've held a few into earnings recently without having a cushion, and it depends how I'm doing. It depends the landscape. If a lot of stocks are doing well on earnings, I'll sort of keep an eye on the theme. I've been doing this again a long time, so I've got a good sense, but that doesn't mean that I'm always right. But generally speaking, you want to have a cushion going into earnings. Now, that cushion should be anywhere between, I'd say, 5% or so to upwards to maybe 10, 12, 15%, depending on the volatility of the stock. We're going to show you one way to calculate the implied volatility of a potential, what's going to happen potentially on an earnings report. We'll show you that in the risk management section. We'll get to that later on. But depending on your position size too, if you have a huge position, you should never go into a key report with big exposure. I mean, if you had all your money into one stock, you're not holding into an earnings report. You got to be out of your mind. Or any key report. So again, I'm going to want a cushion to be able to go into an earnings report most of the time. How about you, Dave?
Yeah, it depends. If I've held the stock for a while, then I'll go through earnings. A lot of it depends on where the stock is. Is it within a base? How's the setup?
Let's just say a new position, Dave. A new position that you're not at a profit. Yeah, brand new position.
Brand new position. It depends on the setup. Like Airbnb, I actually bought it the day before earnings. Just recently.
We bought it too.
Because it was such a nice base, and it was, it was doing everything correctly. And I just felt that travel industry is coming around, or at least in certain areas, COVID is getting smaller. And so it was just the setup was so nice then that, but I didn't buy a huge position. I bought a position to get started. And then when it opened up and it was a great earnings report, then I added to the position. So it also depends on the volatility of a stock. If it's 5 days before the earnings, but the stock can be a really fast mover, sometimes I'll go ahead and buy it before the earnings, 5 days, because sometimes that's a lifetime in this market. In some of these stocks, they can make such a huge move in a few days. So
true.
Yeah, it all depends. There's a lot of different factors. The group it's in, the earnings the stock has before it goes into this new report, how long has the move? If the stock's been going for a year and a half and it's had this huge move and then it forms a small little base, no, I'm not going to take that risk. But if it's a longer term base and it hasn't been running for a year, then I can step in front of it.
See, the problem with asking a question of a master trader is you're going to get, there's going to be a lot of gray areas because again, some things were going to be cut and dry, but with something like this, again, Dave has over 40 years experience. So he's going to have a degree of feel, and there's going to be a number of things, but the black and white answer is that you want to have a cushion. You want to have a cushion. You are rolling the dice. I mean, Dave, you would admit that one thing, that you are rolling the dice. You're going into earnings. No matter how long you and I have been trading, we have no way of knowing what's going to happen on that earnings report, correct?
Right.
Right. We are. So it's an educated guess, and you're going to have to position size accordingly. I bought Airbnb right here. So Dave said he bought it the day right before the earnings. I bought it a few days before, I guess, 3 or 4 days before, on November 1st. So again, but went into this earnings report with a small cushion. So anyway, that's that's the general rule of thumb, is to have some cushion, or you got a position size for a worst case scenario. And we're going to show you how to look at that implied volatility using the options market during risk management.
The natural follow-up question to that, which a lot of people asked: you take a stock, it gaps down 15% on earnings, but the earnings appear to be better than last quarter, looking with good sales, earnings, margins. A, do you sell immediately? B, hold till the end of the day? Or 3, believe the fundamentals and hold for a bounce?
Okay. So that's again, I get very scared when people I get scared for you, not scared for me, because I cut my loss. But Dave, the first loss is your best loss, right?
Yeah. But I won't sell on the opening. I'm already down 15%, but I watch the first even 5-10 minutes to see if it keeps on making lows, and I give it a few minutes because sometimes there's just a crazy reaction to sometimes these earnings, and it opens down 15%, but then it just starts marching back up. And so I watched the first 10-15 minutes, and I put my stop at the low of that first 5-minute or 10-minute bar. And then if it goes lower, then out I go. But sometimes you get these reactions, they're down, and then it starts marching back. I mean, and sometimes you can, I know that just, that happened with Generac just recently, where
GNRC?
Yeah, GNRC. I mean, maybe it's go to a 60-minute where.
Again, I'm not getting a symbol here. What's going on?
GNRC. It gapped down, but by I guess that was on. It looks like the beginning of November, and then within about an hour and a half, the stock was into new high ground. It didn't finish well. It came back down in, but you could have gotten out at a better price. So that's why I give it just.
I don't know where that is. I got the chart up here. I have
November 2nd, or November
2nd.
Yeah, right there. Nope. Yep.
Yeah, right there. Yeah, it opened. It opened down.
Recovered the whole.
and then it was actually up on the day at one point, and then it finished down. So it actually gave you at least a better exit. So that's just an example I can think of. But sometimes that happens, and the stock just turns up and finishes up on the day, and then just keeps on going. So I just give it a few minutes.
I think we have to be very, very careful, though, to decipher, to understand what Dave's saying here, because I'm just really worried that people are going to think that, you have to wait and see if it bounces. And I've had stocks, there's stocks that have gapped down 10%, and we're down literally within 30 seconds or a minute are down 30, 40, 50%. So if you were to ask Mark Ritchie this question and myself, Mark and I treat it exactly the same way. We do exactly what Dave said, only we do it in a few seconds. So let's just say the stock gaps down. It's indicated it's going to gap down really big. It's going to gap down 15%. Our stop is at 8%. It's going to be down 7-8% below our stop. What I do and what Mark does is that we'll literally give it like the first 5 seconds of the open, because what happens a lot of times, it'll open up down. As Dave says, it'll turn right back up. If it does that, all right, we're already at the 15% loss, right? So it's at that point right there. We give it just a couple seconds and see if it immediately bounces. If it immediately bounces, let's just say it bounces 1%, right? We set a stop at the day's low, because we're already at that 15%. We're giving up maybe another 0.5%. If we get slippage, it could be more, but most likely it's not going to be much more than about that 15% that we're already at. So I will give it that few, but I'm talking like literally between 2 and 5 seconds. I give it. If it keeps drifting, I'm out. I have no questions asked. I don't care. I'm out. If I got to pound the stock down and I got to get out down 20%, I get out. I've seen enough stocks implode, and I've been involved in enough times where I vacillated and it ended up turning out really bad, that I know the first loss is the best loss. And so I would advise that if you're in that situation, my advice would be to cut it immediately. And not give it much more than literally 0.5% or 1% more. But doesn't mean to hold it down, just sit here with a loss and wait for it to recover. That's not what we're saying. Yeah.
The other thing you can do too is that I know on TD Ameritrade, you can actually see the trading beforehand too. The trading before the market opens at 6:30, and sometimes the low has actually been made pre-market and is actually in an uptrend. So that's something else that can give you a clue to how the stock is going to open and where maybe it has gotten support, even though it was a gap down.
Yeah.
Yep. Post a breakout for the post earnings drift, will a dip due to a natural reaction, Mark, and then develop a new pivot be viable for you if we have missed that original breakout? And
I'm not understanding the question.
So post a breakout. Will a dip through a natural reaction, which develops a pivot point, be viable if you missed the original breakout?
A dip through a natural reaction? That's where it's throwing me for a loop.
No, a dip due to a natural reaction. Sorry.
Oh, a dip due to a natural. Okay, yeah, through a natural reaction. That's it acting abnormal, and there's no way that I would buy it.
And a quick follow-up would be if you could also explain the cap pattern. So somewhat related.
Yeah. So I wish I had an example. I know there was a couple cap patterns recently. I don't remember what they were, and I don't want to sit here and wait 5 minutes while I'm trying to find it. But as far as the natural reaction is concerned, let me see. RVLV, is that... Yeah, no, I'm just trying to come up with an example. As far as you can buy from a natural reaction. I mean, if you want to try to buy, stock turns back. You don't know, first of all, you don't know a natural reaction is a natural reaction until it recovers to new high ground. As far as that's the way I deem it. The term natural reaction comes from Jesse Livermore. I haven't heard anybody else talk about it except myself. Other than Jesse Livermore. That's where I got it from. And this whole abnormal versus normal action really came from Jesse Livermore, and then, from, to a certain degree, O'Neill and David. And David and I have discussed this at length, and come up with these violations and confirmations over the years that we've been using for decades to determine if a stock is acting right. So until the stock recovers and gets back into new highs, you don't know it's a natural reaction. So basically what you're saying is, can you buy a pullback? Sure, you can buy a pullback. But again, once it's out of the base, if you're buying a pullback that's 10% above the breakout point, well, you're buying an extended stock. So the upside is going to be, probably limited, or the probability of your probability of the trade working out is going to be less, because you're not buying coming out of that base. So yes, you can. If it pulls back right to the breakout point, that would be my preferred spot to buy it. Would be a pullback, or you may be a little bit above the breakout. If it comes all the way back to the breakout, that's showing some weakness. But if it can hold up, and maybe I'm not paying too much more, maybe the pullback is just a couple percent above the breakout, pulls back for 3 or 4 days, starts turning up from that pullback. Yes, but see, again, I don't like to hear that. That's not what I want to hear from, particularly from a new trader, is because that, that's putting a Band-Aid. My goal when I first started this was to get to the point where I bought every single trade I made was bought absolutely perfectly. It's just like when I play poker, I analyze the hand. I want to go back and look, did I make every play perfect? Now, I'm not going to win every hand. And there's going to be times where I start off with aces or drawn to a flush, and I lose, even though I might start off with the odds well in my favor. But did I make all the correct decisions? Did I lose correctly? Sometimes you win incorrectly. And when you're winning incorrectly, eventually you blow up, right? You see it in poker players all the time. You see some guy who's just getting lucky. He's making all kinds of crazy moves, and he's got stacks of chips. Check 5 hours later. They're all gone. He's rebuying, right? And then you get a guy who's disciplined and plays tight, and he'll go for hours and hours and hours, and doesn't make any money, or even loses money, but over time is a winning poker player. It's the same thing with trading. You got to get to the point. Forget about if I missed it. Just get that out of your mind. How about thinking about, I'm not going to miss it, and if I do miss it, I'll wait for the next one that's perfect. That's the way you should be thinking. Once you can get that down, then you can start coming up with adjunct techniques of if you missed it. But guess what? You won't have to. Not most of the time. 90% of the time, you're not going to be missing them, and it's going to be a very it's going to be an aberration, and that's fine. But if it starts becoming the rule, and this is what happens a lot of times, you get this drift where you drift away from the rules, and before you know it, you've got a whole new set of rules, and then you're wondering why you're not doing well, because you've never perfected the first rules. Get it down where you're buying the stock perfect, and you're buying it at the exact perfect. That's another thing that O'Neill convinced me of. See, the real thing that O'Neill played the biggest role in my career is not that I learned technical analysis or learned the CanSlim method. It's that O'Neill convinced me that it was unnecessary to not be disciplined. It was unnecessary to have these other techniques, that this was enough. This was enough. If you got this down, if you got it down right, and you got the fundamentals down properly, you didn't need anything else. You didn't need indicators. You didn't need anything but a few chart patterns, earnings, sales, and margins, and a small list of things that really are what makes stocks move. And that you had to perfect. Once you perfected that, you didn't need anything else. You were completely empowered. And that's really what I'm trying to do with you, is pass that same torch, that to show you that it's all about perfecting the basics. I'm a big Vince Lombardi fan. Vince Lombardi, as you said, we're gonna block, tackle, pass, run, catch better than everybody else. There wasn't no trick plays and a lot of complicated things with the Green Bay Packers with Vince Lombardi. He just drilled the fundamentals to do them perfectly and be better than the next guy. And that's where the real power comes with this. So don't think about, if I missed it. That's like failing before you even started.
Quick question asked if, Mark, you see the stock market as being overextended. Do you avoid taking trades in those conditions?
Again, there's a forming an opinion. You see, if you start thinking like that, you'll be on the sidelines through a giant bull market, and you won't trade. Dave, I definitely want you to comment on this. I mean, how many times have we seen rip roaring markets where we're scared to death. We're scared to death, but the stocks come out of basis and we buy them. We buy them regardless of whether the COVID situation was perfect. We can use it on either side. The market's extended. It's been running a long time and it looks like, oh my God, how much higher can it go? Or the market's in a free fall and the news is so horrible. It's the end of the world and you're terrified but stocks are setting up. Both of those scenarios are the two scenarios that we get into where we don't buy stocks. We rationalize and we let our fears and not let the information guide us. The stocks are setting up, we buy them. Mark Ritchie called me when we turned up from the COVID crash, we got the follow through day. He said, what do you think? This looks horrible, doesn't it? I said, well, stocks are setting up. He's like, yeah, but this looks like this could be a depression. We started, we were both terrified. I was equally as terrified to buy a stock. I told him, I said, stocks set up, we buy them. We get stopped out, we get stopped out. The stocks are setting up. We're going to listen to the stocks. And sure enough, boom, everything took off and blasted off out of basis. And if I went with my gut, I probably wouldn't have bought stocks for a year after that point. It would have taken me a year. I was scared to buy basis for the whole year. Dave, what do you think?
Well, you have to, I keep on going back to the same thing. You have to let the individual stocks tell you if you should be invested or not. If you can't, that's what's so important about working with a discipline. If the stocks are there, if the setups are there, if the fundamentals are there, and the stock starts moving up, you've just got to follow the discipline and go with it. And to say, well, everybody's saying the market's extended. Well, that's an opinion. What is the market telling you? If you can't find anything to buy, then you're in cash. But if you're seeing one stock, break out on one day and you go ahead and you buy that, and then there's another one the next day, and then there's another one next day, you let the market determine for you if you should be, how invested you should be. And not start out with, oh, well, it's extended, so I can't buy it. But then you're not listening to the market if you're listening to, other people's opinions.
Everybody said you shouldn't buy around the 74 low, around the 82 low, around the crash low of 87, around the low of 1990, the low in 2000, 09, COVID. Everybody said you shouldn't buy. When the market was extended in the 80s, in the 90s, in 2000, all those times, there was always the prevailing opinion was market's up too much, market's going into hell in a handbasket. You got to follow the stocks. You got to follow the stocks, stick with the stocks, and let them guide you and get off of these opinions. David and I have been doing this collectively for about 90 years. We've got somewhere in the neighborhood of 85, 90 years of collective experience, and we still can't figure out where the market's going. We follow the stocks. We're not able to do it. So I highly doubt that you're going to be able to, get up to speed and all of a sudden be this prognosticator of market rallies and tops on your own without having some discipline.
Yeah, and there's going to be a time, and who knows when it's going to be. Maybe it's next week or next month or early next year, where you're going to have your stocks are going to start rolling over and breaking trend lines and doing all sorts of bad stuff, and you'll start selling them one after another, and you'll be looking around and you can't find anything else to buy. There's nothing else that's setting up. And then eventually you'll probably be 100% in cash and the market's doing this. so let the market tell you when to get in and when to get out, and that should be your guide, and not people's opinions or extensions off of moving averages and things like that. Because you almost don't. I think we overthink it. And as Bill would always say, is just bend with the wind. When the wind is blowing this way and things are not working out, then you get less invested. And when things are great, you go the other way.
I always try to ask myself, and every time I'm making a decision with the market, in particular, if I feel like I'm fading, am I being a caboose or an engine? Am I following the market, or am I trying to lead? Am I trying to guess? And the most trouble that I've ever gotten in is when I was guessing. And as a caboose, sometimes you get led. You got to change direction. You're the tail and you're whipping around, but you're always going to be in the prevailing correct direction. That's the whole idea, is to get that trend. You're going to be guaranteed to be in the bull markets and out during the bear markets, and that's the key. The key is to participate in the up markets, be out in the down markets. And the only way to be absolutely certain, just like the only certain way, there's one certain way to avoid a large loss. There's only one way. Again, I'm going to go back. I'm really going back to Bill O'Neill a lot here, because these are also the key things that I learned from Bill. There's only one way. He said to me, "You've been doing this for longer than you're alive, and I haven't figured out a way to mitigate a large loss other than taking a small loss." He said, I have not figured out another way. If you figure out a way, let me know, but there is no other way. There is no other way. Every large loss starts as a small loss, and the only way to avoid a large loss is to accept a small one. That's the only guaranteed way. And it's the same thing. The only guaranteed way to be in a bull market and out of the bear market is to bend with it. If you argue with it, then you could sit on the sidelines and sit there and wait, because the market's overbought, and it'll stay overbought as it goes up for months and months and months.
One of the other very popular questions, it's two parts. The first is, what percentage of stocks pull back after the breakout mark? And Anthony, you could answer that one quickly.
Well, I would say probably half. I used to be more into the studies, and we would do a lot of, big studies on this stuff and reverse factor model it. But what we found was, about half of the stocks will pull back to the breakout.
And then the one of the most popular questions, if a stock breaks through the pivot in the morning, reverses back, falls back into the pivot area, soon thereafter, when it's rising again through the original pivot point for the second time in the same day, will you use that? Could you use that as a buying point?
Okay, so that's a little trickier, and that's a very good question. Let's just take a look at this right here, and take a look at this, and we'll zoom up, right? Because this is the breakout day right here, right? Let's try to make this a little more. And again, I got to hide I got to come up with a better way for the zoom bar, because it just kills me. Let's see, hide names, hide floating mean. Okay, there we go. Let's just draw this line right here. That's the pivot point right there. Okay, that's the level. That's the buy point, right? So you can see that this stock broke out here. This is the day that on 11/1. This is the day that it broke out. Now, on this day, and on your example, you break out, then you come back down, and you're saying when you come back up, okay, let's say it came back up intraday and got through that pivot point, could you buy it there? You could. I mean, I'd rather, again, you see, here's the thing. Why are you buying it there when it already had broken out and you had that opportunity? Okay, maybe you missed it. I understand. But I want you to get good at not missing them, not good at buying stocks that fail to break out. I want you to buy a stock at the perfect moment and be in a stock, because the stocks that really are the rip-roaring winners usually just take off and get away from you, and you don't get this opportunity. All said, if you were to take and look at, say, the next 10,000 trades, and you trade the ones that pull back and don't break out well and have this scenario you're talking about versus the ones that break out and just go and you don't get it that second chance, I guarantee you that this group is going to dramatically underperform the other group. So you want to get good at being in that group that's going to perform the best. And that means that you got to get the breakout. Now, again, when you're coming off of a bear market or a correction, you sometimes get a lot different action where they just come out and they just take right off. Now, another thing you can do, this is even being more aggressive. In a situation like this, I'll tell you what I do sometimes. And I might even do this to add to the position, or maybe, it's a stock that I just didn't see, and it's brought to my attention. I missed it because, and you might miss it for this too, you just didn't see it, right? Okay, so now the stock breaks out, comes back in, but now it's trading very close to what I call the danger point. So let's just say that this low, this is the pivot, right? That's my stop. And let's just say that's only 1 or 2% away. Well, now I might buy it right here by the low, because what's happening now is that the probability is definitely lower. The stock didn't just break out and take off, but I've now cut my stop way down. So now my stop is only 2%. And if this, in fact, let's say this stock, that this price looked like this, okay, that's a problem. Now we've got a full engulfing of the pivot. We do this. This is what I call the megaphone effect, where now instead of volatility contracting and you getting asymmetric leverage, which asymmetric leverage would look like this. Watch this. We take this and we do this. Whoops. Man, oh man. Pain in the butt this thing is. See, that's asymmetric leverage. See, I have the upside, but I cut the downside off. That's asymmetric leverage. Now when we do this, now it's a different story, right? We've got the volatility on both sides is equal. So now that would be abnormal, and I would be getting stopped out. That would be my original stop. That's my stop if I buy it on the breakout, right? That's my stop. So let's just say that's 5%, but now it's 2%. So now I've got more than double the chances to take this trade. I've made up for the fact that it's a lower probability because my stop is tighter. And it's not just tighter just because I came up with an arbitrary number. It's tighter from a technical standpoint where this would look very abnormal and we'd get a clear cut. So if it's very clear cut, if the price action is clear cut that it's soured, the trade is soured, and where that price point is very, very small risk, you can try to buy that pullback and then hope for a good close. If you get a good close, you're in great shape, right? If not, then you got to watch the next couple subsequent days. But again, you're coming from a point where your stop is tighter. And this is getting into more, expert thinking, if you will. This is getting more what I call creative. Once you get the mechanics of buying at the right point and understanding most people can't even decipher a chart that looks good. They can't even get that down. That takes a long, I don't say can't, but it takes a long time, right? They can't get it down right away. And you don't want to start bringing in this complex stuff right off the hop. If you first become successful at everything being textbook, if you can't get it down textbook, I assure you, you're not going to get it down. I mean, you might get lucky every now and then and you play these more esoteric, plays, but believe me, if you can't do it in the basic fashion, the more complicated methods are not going to work for you. You practice and get good at the basic methods. For those of you that are experienced at this and are already really good at the basic methods, I probably don't have to answer this question. You probably know a lot of this and you've seen a lot of trading. You see how the nature of price, and you understand risk reward and trading near the danger point.
Question being asked on a stock that is demonstrating tennis ball action. Would that not be a lower risk entry point, seeing that the stock is recovering from the pullback?
Would what be a lower risk entry point? Where?
Once you have the tennis ball action confirmed on a natural reaction.
No, it would not be a lower risk because the stock is extended now. So you have profit takers now. Once the stock starts getting extended, you're going to have short-term profit takers that are going to come in there, and sometimes the stock will come back 8-10% naturally. It's up now. It goes through that natural reaction. You're talking about a recovery to a natural reaction high. Now the stock might be up 12-15%. It could pull back 8 or 12%, and it's still acting relatively normal, and you're stopped out of it. So that's the whole idea. You have to put yourself in a position where you can allow the stock to act normally, and normal behavior doesn't stop you out. Abnormal behavior stops you out. But if you buy stocks that are extended, now what's normal from an extended stock is going to be too much risk and too much volatility for you to be able to manage your risk. So now you won't know. You're just going to get stopped out, even though the stock's acting fine. Now, if you're at a profit already, and maybe you take some off the table, you've got a cushion, you've nailed a little profit down, maybe into short-term strength stocks up 20%, you can now maybe go through that 10 or 15% pullback because you've now got a cushion. You're not risking your original capital, and maybe you've banked some profits.
Okay.
Again, I don't know what this fascination with buying, it's like we show you the exact time to buy, and it's like, nope, I want to know how to buy after that. Like, why? Why not just get it down to buy it at the perfect time? Are we so afraid that if we miss it, that we have to get on this stock? See, that's that FOMO. This is the thinking. When I hear these questions, I automatically know that's a trader that's going to have trouble. It's going to have trouble. If that's a new trader asking those questions, I automatically know that's a guy that I'm not giving my money to. I can tell you right now, I'm not giving my money to that trader. He's got a lot to learn. All right. And where to focus. So focus on getting it right. Forget about the band-aids. And well, if I don't get it right, can I buy it here? You got to get off of that thinking. That's just not the way to think.
Question: if your VCP setup is applicable to other securities like crypto or Forex, and also
Absolutely.
Would it work on other stock exchanges around the world?
Absolutely. It will work better on many of the stock exchanges around the world because they are less efficient. The U.S. market is one of the most efficient. The S&P 500 and the bond market, the 10-year and the 30-year, the bonds and the S&P 500, the equity, the main benchmark for equities, are two of the most efficient indexes on the face of the planet. You go to somewhere like, I don't know now, but back in the day, the Chilean market, or 100 stocks on the whole stock market, 100% moves. Back in the day, I used to have a client, who turned out to be a very good friend of mine, a client that was managing money in Chile and traded the Chilean market on with my strategy, and the stocks would move up 100% in just a couple of days sometimes. There's tremendous opportunity. I think the Indian market, there's a lot of opportunity there. But the less efficient the markets are, the more you're going back to taking our markets and going back to like the 1920s in some of these markets. So yes, they will work and they will work. It will work very well anywhere. It doesn't matter. This would work if you were at an auction and just auctioning off iPads. It doesn't really matter. The market is an auction marketplace. If you were to chart any auction, you're going to find bases and breakouts and supply and demand. When there's less supply, you're going to have the price is going to go up. See, the thing is, you have to stop looking at this like it's some magical hocus pocus or some business that has different laws of supply and demand, laws of business. It's this is an auction market, right? Study what that means, what an auction market is. It's no different. This is just an auction. Right?
And it works on all time frames too, and you might have said that, but you can see it happening on minute charts and hourly charts and daily charts, weekly, monthly, all different time frames. It works.
The same process of what I showed you before of trapped buyers, bottom fishers, coming up that right side and intersecting with profit taking and people getting even. And then when you break into new high ground, all the supply is gone. That exact process is going to work on any time frame just on a smaller level. So the price movements are going to be shorter and shallower because there's less supply. It's once you understand this is something that, Bob, you took a long time to really understand about supply not coming to market. We used to talk about it every day, and he'd be like, "Wait a minute, can you explain this again to me?" This went on for like 2 years. He kept making me re-explain it. But once you understand this, you really get so empowered, because the empowerment doesn't come from, it's the same thing in sales. Nobody can be a great salesman unless they believe in their product. The greatest salespeople are the ones that sell the best sale. As Zig Ziglar said, the best sale you can make is to sell yourself. Once you sell yourself on the product that you're selling, you could sell it with conviction. You believe in it. It's the same thing with a trading strategy. If you don't believe in this 100%, you're not going to make it. You're not going to make it as a great trader, because you're going to switch. You're going to doubt yourself when the pressure's on. You're going to slip. You're not going to be disciplined. You're going to make, and any time when you go back and you see when you're making mistakes and you're slipping, it's all because you've lost faith. You've lost your conviction in what you're doing. And you may not really know what you're doing because you don't fully understand it yet. That's why it's so important to understand that I'm not just trying to show you the tactics and the techniques. I'm trying to show you the lineage behind it, all the mentors that I've had, and how this goes all the way back to the beginning of the stock market. Nothing has changed since the day they opened the stock exchange. And nothing will ever change. These are timeless principles. That's why I'm able to win the U.S. Investing Championship 24 years later, the only 2 times I've ever entered. That's why David was able to win the U.S. Investing Championship 3 years in a row. And because these are timeless principles, they're not going to change.
Even though this is a question out of order, but on that note, a question was being asked to David. Are you considering joining the USIC again to see if you can win?
I was waiting for that, man.
Oh, really? I actually did it 5 years in a row. I mean, Mark said, I've won 3 years in a row. The following year, I was even on the year because I started breaking rules and was so concerned about results that I didn't enact what I should be doing exactly right. And then the 5th year, I came in second. But I don't know. It's a lot of pressure. It's a lot of that's why I returned my money to my hedge fund managers, my hedge fund investors. Because I was just getting tired of the performance pressure all the time. I enjoy the market so much, and I have to worry about the phone ringing and a client being upset with last month's performance. So, or saying great job type of thing. I love what I do, and to add that on top, it would take away the fun. And that's how I started investing in the market, and that's how I want to continue it.
I'll translate that. I have screw you money and I don't care.
Yeah. Well, you get to a point. Yeah. I'll let my son do it. And Sean and Thomas, they can enter form, and they've been doing pretty well. So yeah, I'll pass on the torch to them.
Yeah, I don't know what the heck was wrong with me while I decided to do it, but it's in hindsight, it's turned out to be a good thing. But it was all downside, all risk, and but yeah, it's it could be a lot of pressure. I try to just do what I do and let the chips fall where they are and not even think about it. But absolutely, but I think if Dave really wanted to and flipped his cap into U.S. Investing Championship mode, I'm sure he would not embarrass himself.
Mm-hmm. Yeah. Question for you, David. Can you please explain the wedging action in stocks that you referred to? Oh, no. And then there was this follow-up on what you referred to as the porcupine nature of a stock chart.
Okay. Well, if you bring up Nucor, NUE, I'm looking at it on a MarketSmith chart, but it's the action recently over the last 3 or 4 weeks. And let me see how it shows up. Yeah, you'll see that starting probably go back 2 weeks ago, Mark, from
right here.
Yeah, right on there. And start looking at all the days where it traded higher and closed mid-range or closed near the low of the range.
Almost
and
every day.
Yeah, it just couldn't hold the high. I mean, and you see, it's not a sign of strength. And I don't know. To me, it looks like a porcupine where the quills are positioning up, but the close is on the fur of the porcupine itself. And so when I see that, I'm going, that's just not a strong stock. I still have a position in Nucor. And today, we'll see. Today, I mean, we're halfway through the trading day, and it's actually up a couple points, and it's on right near the high of the day. So far, so good. Maybe it's going to change, and it's going to break this little downtrend over the last 5 or 6 days and regain strength, because it was a good stock earlier in the year, and then went through a correction, and then they had earnings, and the earnings were pretty good, and then you got the transportation bill that was passed. So but then you had the tariffs that were taken off of European steel. So I think there's a few different things overhanging it, but right now it's acting a little bit better. But I just don't like when a stock does that, and does it more than 2 or 3 times. And you have to say, what's wrong with this stock? So I have a smaller position, but if it can break that downtrend and start moving up on some nice volume, then I might be adding to the position.
So let me also add here. If we draw a line, right through, as I say all the time, just wherever the pivot is, where that right side is developing, whether it's a cheat, a low cheat, you start at the high of the pivot, you draw the line across, and then you see to the left what you have for supply above that line or right at that line. So now what Dave's talking about is, you see all these closes here, 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 here. I mean, almost every single day is a reversal. It's closing down in the lower. These are not good closes, a bunch of bad closes. Now, if you come all the way to this left side, there's a bunch of them here too. So you can see that there's a lot of supply from the 114-ish level up. That's where all the supply is. Now, that doesn't mean that you necessarily you stay away from the stock just because of that, but that's telling you that it's not acting great right now, and it's showing that there is a lot of supply. So that's even more that you want to see it set up right at that point, quiet way down, and then clear that supply. So let's use our imagination. All right. Let's just say that this stock has a good couple of days, comes back up here. And then we start quieting down and really tightening up, right? Let's even get it super, super tight, right? We put a little fractal in here. Okay, so now we take that pivot, we draw that line, that new pivot that sets up. Now, if this were to break out here, right from here, now we're really meeting all the criteria. If this volume was real low, we're super tight. Now you see we're clearing out the majority of that price action, and the price action that is left is further away on the left. So the further away it is, the less meaningful it is. Okay, and we've moved up. We're closer to the old highs. So we've eliminated some of this supply here too. We've got the profit takers and we've got the trapped buyers, right? You're coming back up to the trapped buyers, and the profit takers are taking profits. So now why do we want it to tighten up? Again, we're trying to ascertain when this supply stops coming to market and it's exhausted itself. Once that happens, the stock now is ripe for an explosive move because there's no more supply in the stock. Again, I have to credit Bill O'Neill. This is a concept, supply not coming to market, just like with Bob, when I passed that on to Bob and said those words. You got to watch and wait for supply to stop coming to market. Bill O'Neill said it, and I had no clue what he was talking about for like 5 years. For like 5 years, I kept pondering supply not coming to market, and I had it wrong so many different times. I thought that I understood. I think I've gotten to the point now where I can explain it where somebody can know right away what we're talking about. I think I've gotten better than my predecessors at illuminating this through examples and through the towel and the VCP and all that. I think now people can understand it a bit better.
And Mark, go
Bill
back
wasn't exactly the most patient man, was he, Dave?
No, he would chop you up to pieces if you were.
Let me jump in before you do, Dave. So every one of you can thank me that Mark had to learn how to properly communicate to teach a dummy like me how to do all this. That's why the Master Trader program is as good as it is these days.
Yeah, Dave, don't lose your thought, because I want to make sure we get what you were just about to say. But yeah, I just want to say that Bob is absolutely right. A lot of what I've developed, believe it or not, were teaching tools to teach Bob. Bob's been with me for 17 years. Okay, so this goes back quite a ways. When I was teaching him how to trade, and he was actually day trading. That was his forte. He loved the day trade. When I was teaching how to trade, I came up with a lot of ways to train him, and also other people that worked for me at my office. And that just became part of what went into books, and then became Master Trader program. Was all this chronology of building these training techniques. I didn't come up with this to train myself. I knew what a proper pattern looked like in a VCP. I didn't even call it a VCP. This was all to pass the knowledge on and to train others, because I saw so many people misinterpreting the price action. Go ahead, Dave. Sorry.
Well, I was going to say, and what works the best is that 2x4 you keep behind your desk there to go over and whack Bob in the head when he's.
That's right.
He doesn't do it correctly.
There's been many lumps.
Many
lumps have been given.
Dave, did you have an example of wedging?
No, I just had an example. Yeah. If you go back into July, move the chart back on Nucor, and look at as the stock is going through an uptrend at the end of July and early August, you'll see. Well, even you can look at any uptrend, but look where the closes are on most of those days. Most of those days, they're closing in the upper half, the upper range, or even close to the high of the day.
Yeah, I actually bought it right here, coming out here.
Yeah, and see, look, I mean, and you could go back to when it was 90. Most of the closes were on the high of the day, or close to the high of the day. And see, that's why when you look at your individual stocks, you can see, okay, which ones are stronger, which ones are closing on the high of the day, which ones have the stronger volume. And that can lead you to holding stocks, through holding stocks and staying with their uptrends until they start doing something like what Nucor has been doing recently. Now, hopefully that's going to change, but we'll see.
Yeah. Yep. And this came out very explosive. I made a nice quick move here. I was able to grab, I think it was about 20% off of this. Yeah. 20% move in just a couple of days, 4 or 5 days.
Yeah. We had a couple steel stocks. Mm-hmm. Did you have a wedging example, Dave, to explain wedging?
And I'll look, but give me a few minutes.
Mark, the next question is asking if you ever use a time stop to exit a trade, and how long will you wait for the trade? I do use a time stop. Sometimes they're arbitrary, and I just say to myself, like during the day, like if it doesn't go today, I'm out. I want to get it just right, especially if I take a huge position. If it doesn't go on time, I don't want to go overnight with it, with a big position, and I might just get out or sell a good portion of it. But from saying X amount of days and having a formula that if 5 days is the cutoff, I don't have that. But what I can tell you is that the breakouts, when you have a breakout, the first couple weeks after the breakout, that's really where all the action should happen. That's what I'm watching. I'm watching the first 3 or 4 days to see how that initial breakout was. If it fails, then I watch it really carefully, and I got to look for those violations. Natural reaction shouldn't be more than a couple days to a couple weeks. So if they're longer than that, the market should be a factor. Like for instance, you break out of a base, and now maybe it starts acting a bit squirrely, but then the market rolls over, right? And now the market goes into a pullback. Maybe it's an 8%, 6% pullback, and it lasts 3 or 4 weeks, and the stock goes sideways, longer than a couple of weeks. The market's down, it's holding up, it's holding its stop,
It's not doing anything crazy, but it just isn't going anywhere. That would still be natural because the market is not acting really well. Then maybe the index is, and you're just holding the stock back, but it's still holding above your purchase price or even your stop. So again, but your stock should work out fairly soon. So you're trying to time them just right. So if they don't work out within a number of days or a couple of weeks, well, then you got the timing wrong. Whether it's because of your analysis of the stock or the overall market, just it might not be purposely. You might have not got the timing wrong. Maybe you bought it at the right time based on the chart, but the timing is just wrong, just simply because the overall market started getting into trouble. Either way, you got the timing wrong. So you've got to admit it certainly if it hits your stop. But again, that's how I look at it. Generally, I'm more looking to see if it's acting abnormal. Like if this right side is way this right side here goes on and on and on. Well, I know that's just not how charts look. It's abnormal. It starts, building a pivot point that's way, way too long, and the symmetry is starting to look skewed. This is back to David saying, it doesn't have the look. We've looked at so many charts. After a while, you're going to look at a stock and you're going to go, wow, that looks nice. That's a pair of aces. May not definitely work, but that's a high prob trade. That's got all the characteristics. That's got the look. Just like Dave is saying, looking at these, all these reversals, referring to it as a porcupine. These are things that, you'll see now when we point them out. But I assure you, when you first start doing this, you're going to be looking more at just the general shape, and you're going to miss all these little nuances and all the little volume clues. You're not going to see all that. That's going to have to build over time, where you start to work that into your analysis. You're not going to get it all. You're not going to be an expert at reading a fingerprint. You're going to look at a fingerprint and they're going to look, okay, yeah, that looks like a fingerprint. But in that fingerprint, an expert can go in there and there's all kinds of things. I mean, go and study about, I was fascinated with fingerprints when I was a kid. They had this expo where you went and it had the police and the detectives there, and the kids would go and they would fingerprint you, and they gave you this little book, and it talked about how in the fingerprint, they've got names, like almost like we have names for patterns. They have names for all the little patterns in your fingerprint, and everybody's fingerprint is different. It's amazing. Everybody's unique with this fingerprint. I was fascinated with it. And then I was a musician for my whole life, and I could read music. So I really can relate to this. I can relate to these wiggly lines. And I love them. I'm fascinated with them. So you have to build this into your repertoire, and you're not going to have these X-ray eyes overnight. I've learned a lot, even doing these master trader programs. I've learned a lot from Dave, and I'm sure, he's picked up techniques from me with cheat areas and these things that I use. We pick up techniques from each other and educate each other and improve our analysis. And we're still building upon, it's a perpetual learning curve. This never stops. We're just getting better and better at it and increasing our understanding of all these little wiggly lines.
Mark, quick question. Do you look at the shares in the float or outstanding number of shares in Market Smith? And if you do, what are you looking for in the number?
Well, the shares in the float are most important because that's what's available for trade. And that's really, sometimes there can be a pretty big discrepancy. You can have 20 million shares outstanding and only 4 million shares in the float. So the float would be the most important. But, if you were screening for stocks, it's okay just to screen on shares outstanding. If you want to come up with, a screen that has a certain, size base or something, so you can screen on shares outstanding. But ultimately, the float is more important.
Question for you, David. If you could share your historical average gain and average loss per trade. Artie wants to know.
I haven't calculated it in a while. But I think the key to learn is that you keep those losses small, and every year you could have one or two really nice big gains, and it makes up for all the very, very small losses. I when I was going through what I had done this year to to share with IBD Live, bigger gains, some of the biggest gains and some of the biggest losses. I had very few losses that were ever got above 7 or 8%. I had a lot of losses in the 1, 2, and 3% range. But then I've had some very, very large gains that make up for those losses and provide a nice return for the year. So it's just something that you should study yourself. When you study your own winners and your own losers, you can find different patterns that start showing up that you might be doing, and to correct those mistakes is where you're going to get the greatest greatest increase in your performance, when you start cutting out the mistakes. But it's something that you have to do yourself and not rely on anybody else, because you're the one who made the trade. You know exactly what you were thinking. And
Dave, I just want to say that Dave is being kind, and he doesn't want to contradict anything that I'm teaching. And the real truth is, and we're fully transparent here, the real truth is that Dave, he's got an intuitive feel for this. He doesn't calculate his numbers. I mean, that's the real truth. He doesn't go into that mathematical calculation to the level that I do, or I certainly suggest you do when you're starting. Like even my numbers, I know where I'm going to fall. Like I know the numbers. I mean, I know where they're going to be. I don't really have to look at them, even though we do look at them. We still look at our numbers, and we do get forensic and mathematical about it. But I know, my loss is going to average between a couple percent and 5%, 6% maximum in the worst possible times. And the best time is going to be 2, 3, 3.5%. That's just where I am, because I just know this is what I've been doing for 38 years, and I do the same thing over and over. My swing trades are going to average really good markets 10, 12, 15%. If I'm real short term trading, might be 5, 6, 8%. I'm going to have that 2, 3 to 1. Batting average is going to be anywhere between 35% in the worst of markets and 65% in the best markets, and be 45 to 50% over time. But Dave really has an intuitive feel for that. I can assure you, if we calculate all his numbers, average gains can be bigger than his average loss. Batting average time he holds the winners is going to be longer than the average time he holds the losers. Yeah. His largest gains are going to be bigger than his largest losses over time. His plane is going to be flying upright. There's not going to be a single instrument on his instrument panel that is going to be inverted. But the real truth is, Dave, you don't calculate your numbers, right?
No. And early on, I would just get the chart books that you brought up early in this session. And I would just cut out every chart and study those charts of where I bought the stocks and where I sold the stocks. And that's the greatest lesson that you can learn. My losses are usually, they occur over just a few days or a week or two at the most. I don't hold on to losers for any length of period of time. It's usually a very, very short-term loss that I take. The gains are the ones I hold on for a much longer period of time.
Yeah, I'd be willing to bet that your ratio of gain days to loss days is probably very large.
Yeah, and the other thing too is I just do not like red in my portfolio, and
right.
And so to me, I hate to use the analogy, but it's like a cancer. You keep losses in your portfolio and you let them go, and it starts spreading to the rest of your portfolio, and all of a sudden you've got some horrible performance. Where I just cut those things out as quick as I can and just move on to another stock or wait for that stock to set up again. But I just do not like red at all.
We're constantly using forced displacement, and again, like a time stop, we see red day after day in the portfolio. That's the stock that's not performing, so instead of hoping and wishing and reading the fundamentals and going, okay, it's a good company, it's not performing. Again, this is really, a lot of going back to Bill O'Neill on this, but Bill O'Neill he was screaming this at a seminar one time. There's a guy kept peppering him about fundamentals and saying, well, what if the fundamentals are good? He literally was screaming and pounding the table and saying, look, if the stock is so damn good and the management is so good and everything's so great, why isn't the stock going up? Why isn't the stock going up? Why is it going down? If everything's so great, if you're so smart and you know everything about the company and it's so wonderful, why isn't it going up? And that's what I always say to myself. The stock's not performing. Okay, maybe it'll perform tomorrow, the next day, but that's guesswork. That's a speculation of another kind.
Just to prove that point, and I'm the same way, because I learned from Mark that, for those of you who are not private access members, but for those of you that are, we have 13 open positions right now. 10 of them are winners, 3 of them are losers. The losers is a fraction of a percent, and the other 2 are around 2%. But in our winners, we have a 20% winner, a 10% winner, a 13% winner, a 17% winner, another 17% winner. So having that green just makes you feel happy.
Yeah, and this is more short-term trading too. So regardless of the time frame, day trading, my numbers are still going to be, all the ratios are going to be positive reward to risk ratios.
And another thing, which I do want to make sure I share, because David taught a lesson that I took very deep to heart. One of your first years, David, is your mental health buy. Can you just talk a little bit about the mental health buy?
Well, you want to be balanced, and you want to be kind of mind neutral and not bring any emotions into the market. And this, it started out as a joke when I was running my hedge fund with the individuals I was working with. When we missed a stock, and it just broke out, and it had a huge, it was up a lot, that sometimes, instead of having to bring that stock up every day that was going through this massive run, what we would do is we would just buy a very, very small position, just so we're into the stock and just so we're not psychologically damaged on that by looking at it every day. So we'd buy a little small, tiny position. And sometimes what would happen is that the stock would pull back or set up again, and we would actually start adding to our position. And sometimes that got us onto a very big winner. But it would just be something to say, hey, I've got a position in the stock. I'm going with it no matter how high it goes. So that's it. It sort of started out with a joke, but then sometimes it can turn into something that can be beneficial.
And something, Bob, just something to talk about here, as far as a lot of times I find that people that start doing this, they're trading too large. What happens is they get in here, they're all gung ho, and they just see the upside. They see, they're empowered. They learn from Mark Mינארוווני, David Ryan, some of these market wizards, and feel like, okay, I got the key now, and they rush in there, and next thing you know, they're under pressure. They get into some trades that don't work out, and they don't realize it, but the emotional pressure and the financial pressure is just too much. So what I recommend is that you start off small, and you start off trading. And once you can do well small, then you incrementally move up. Don't be in such a hurry just to get in there with all your money and start getting greedy. The key is that you learn yourself and you learn your emotional thresholds. And Bob has termed it the pillow factor. We say sell down to the sleeping point. And I'm not sure if O'Neill started saying that, but I got it from somewhere. Sell down to the sleeping point means that, you position size to where you can sleep at night. And if positions are keeping you up at night, I assure you discipline is getting sacrificed. You're going to sacrifice your discipline. You have to learn over time, for many of us at least, have to learn how to trade larger. With the more risk. The dollar amount makes a big difference. Now, on the flip side, here's the negative of it. When you trade really small, especially if you're paper trading, you don't make the right decisions either, because it doesn't mean anything. So now you have no emotional pressure whatsoever. Perfect example is I used to go to the casino and I would play a 10-25 no limit game, and sometimes a 25-50 and even a 50-100 game, which is a fairly large game. I would play those games regularly, but you'd get there sometimes and there'd be no table. You have to wait to get on a table. So I would go and play. I might go play a 1-2 game, right? Which to me is like peanuts, right? So I'd actually go lose more money in the 1-2 game than I would in the 10-25, because I'd just be throwing chips around and treating it like, it's no big deal. The next thing you know, I've blown a bunch of money just because I'm fooling around and not taking it seriously. The same thing in the market. You've got to try to dial it in where the emotional pressure is enough, where you stick to the discipline, but not so much or so little that you don't stick to the discipline. There is a zone for everybody, and everybody's level is different. Everybody's level is different of comfort. That's why position sizing, some people might not be comfortable with taking 25% or large positions. And some people, they just got to have, they got to have their, they got to have it on the line all the time, and just huge positions is the only way they get excitement from it. Some people trade purely for excitement, and it's just, everybody's so different. And you've got to really, as Dave said, it's really important, your personal trading, your numbers, and to really hone into what you're doing, and then base everything off of that. When we're going to talk about numbers and results at the end, like you're not going to believe. If you haven't been here before, wait till you see the last day 4. It's pretty incredible when we get into the numbers. Okay,
Mark, we need the workbook up.
So we do have to, but shouldn't we take a break? We've gone like an hour and 20 minutes now, right?
Yeah.
Why don't we take a 5-minute break, and then we'll come back, and maybe we can get to some questions that we go into the workbook, and we start going over some pages in the workbook. How about that?
Perfect.
Yeah.
So
okay.
With that, guys, we'll pause here for 5 minutes.
Take a breather.
Up, walk around, get a drink, go to the bathroom.
5 minutes we're going to do? 5?
Yeah.
Okay.
Sounds good. Okay, we are back with the 2021 Master Trader Program question and answer session with Mark Mינארוווני, David Ryan, and I'm Bob Weissman, your host for today's session. A reminder that the encore presentation of this will be this evening at 6:30 p.m. Eastern Time. Also, a quick reminder, on Thursday at 10:30 a.m. Eastern Time is the interviews that Mark is doing with Larry Height and Tom Basso. And the replay for those interviews will be Thursday evening, 6:30 p.m. Eastern Time, before, of course, we reconvene for the weekend activities on Saturday and Sunday. So, Mark, if you have your workbook up, we're going to start on page 22. And David, if you do happen to find a wedging example.
Bob, I'll be there in 1 second.
Oh, okay. If you do find a wedging example, just anytime, just let us know, and we can come back to that question too, Dave.
Okay.
Actually, one quick question I can ask while Mark is getting ready. The in between is Alexander is asking if you, do any pre-prepping or pre-staging of an order, essentially. So you're ready to fire it right off, or do you just wait for the alert to go off and then you kind of go through the process of actually placing your order, your trade?
On some systems, you can pre-stage them. I know on Fidelity Active Trader Pro, you can get it all set up, and all they have to do is hit a button. But then on TD Ameritrade, at least I'm not using Thinkorswim, but I guess you can get it set up, but you can't do multiple orders set to go. You can do that on Fidelity Active Trader Pro. So I guess it all depends on who you're using as a broker.
Yeah, I know.
I'm sorry, I didn't hear the question, so I was just had to get on a call for a second. What was the question?
Well, just going to say, TradeStation does allow you to pre-stage orders, and you can have multiple. So you can have everything you need all ready to go, and you just click on the line and boom, fire, right-click, send, and you can have all your orders ready from your homework the night before. So therefore, you're taking being able to execute immediately as opposed to then processing.
Yeah, I like the stage function. I use TradeStation, and the stage function is nice. You can stage an order, set it all up ahead of time, and then boom, you just go to the staged orders and fire it.
Yep. All right. So on page 22, Mark,
from
the workbook, is the question being asked is regarding IPOs. Many companies these days stay private much longer and come to the market much more mature in their cycles. Of course, the unicorns, private equity firms having more funds than ever, buying up private and making companies private or even before they come public. Does this factor into your thinking of late, except for this current year where the IPO market has been on fire. But does that factor into any of your considerations for stocks with historical IPO timeframes?
Krispy Kreme was around for like 50 years before it went public. I mean, I don't know what that has to do with anything. If the business is doing well and making money, you just apply all the same rules. I mean, that's not going to change anything.
Okay. Page 54.
54?
Yep.
54. Gotcha. Yep.
Just is asking if you could just share the distinction between the 4 trend templates that you have on MarketSmith and how when you use each of them.
Well, we're going to go over this when we're with Arusha from MarketSmith on live trading. We're going to actually go over MarketSmith. So why don't we just wait until then, and then we'll actually go over these then.
Okay.
Yeah.
Page 65 is asking if you can review this math again, how you go from the 100 to $1,600 to $25,600.
You compound it. Whatever that's doubling. That's double. Where I was saying that when I was talking about Cisco had earnings of 100% per quarter for, I believe it was 16 quarters. So I did just 8 quarters of doubling. If your earnings were $100 a share or $1 a share, whatever you want to call it, or even if you could say the price of the stock, if you doubled, this is 1, 2, 3, 4 quarters, 4 more quarters. So this is 1 year, that in the example. So you're at 256 times. Your earnings would be up 256 times. Do that another 4 quarters. I don't even know what the number would be. It's going to be astronomical, though. I know that. You can do that math if you want. But again, this is the power of earnings. If we were talking about earnings, when earnings are really strong, and some of these companies have triple-digit earnings quarter after quarter after quarter, even just for a year or two of that type of earnings growth is not going to be able to be fully discounted in the price of most stocks, especially if they're smaller stocks that not many analysts are following. So this is where the inefficient pricing comes from, and that's what we were discussing at the time. But this
on that note,
this is a doubling. This is just 100 to 200, 200 to 400, 4 to 8, 8 to 16.
There was a related question on earnings. If you have a stock that is earnings of triple digits, would it be a major factor if it then, do you consider the growth rate at that point is what he's asking, or is that just super high that it's good enough being just super high triple digits?
Do you consider the growth rate? Well, I'm not really looking, the growth rate, I'm looking more for a relative measure. So I'm not requiring the growth rate to necessarily have a great 3 or 5 year growth rate. I'm looking at the current quarters, but I'm looking at, I know the situation of the company. I know about the company. I know what the company's industry is, what they do, and how I'm going to apply, the rules or the techniques. So for instance, like we said in fundamentals, if this is a turnaround situation, well, I'm going to look at, you're going to have a negative growth rate. That's why I need to know what type of situation. The very first thing that I do is I find out what kind of company I'm dealing with, what category I'm dealing with. That's why we started off with categories. So we're in a turnaround situation. Well, we know that they're going to be on hard times. That's why they're turning around. They're turning around from a recession or a problem with the company. So you're going to go against easy comps. The growth rates are either going to be very low, probably single digits or negative. And now you're going to want to see those current earnings coming in real strong because they're going against negative comps. Now, if we're talking about a growth company that has been sort of chugging along, non-cyclical, you might want to see a growth rate that's a decent 3-year, 5-year growth rate, but I'm still going to want to see some acceleration. See, Wall Street loves when things are doing better than expected. That's basically where you get rewarded for better than expected. You get penalized for worse than expected. So if the growth rate is 15%, and now suddenly you're seeing quarters at 20, 30, 40%, that's an acceleration. You can have a growth rate. I remember Dell Computer had a growth rate of it was like 80 to 100% in the 90s. And then all of a sudden they started having quarters where they're up 40%, 30%. And the stock topped, even though that was still appeared to be really strong growth. it wasn't compared to how they were growing. So I look at the growth rate as in relative terms. How about you, Dave?
Yeah, I mean, you can see if it's growing 10, 15%, then it moves up to 20 to 25%. That's an acceleration in earnings, and that's always much very favorable, and even better than something that's just kind of flatlining in terms of growth. So acceleration is important in the best of growth stocks.
There's almost always some form of acceleration, whether it's acceleration versus growth rate, whether it's quarterly sequential, year over year quarters that are sequentially accelerating, whether it's a breakout year where you have a year where you're seeing a breakout versus maybe a flat period of 3, 4, 5 years. There's almost always an acceleration in growth somewhere. And so that's your job to look at the fundamentals, is to find those stocks that are having that acceleration or have some conditions that are going to lead to some acceleration pretty soon. Because you're not trying to speculate too far out. You want to wait until that those earnings and that growth is on the table.
On page 100, if you can expand on the code 33. First off, the question is if the profit margins or net profit margins versus gross.
I know. I saw a bunch of questions on the margins, and with MarketSmith, you can look at after-tax, pre-tax, gross margins. So to get really, really specific, different industries, you might look at the margins a little bit differently. But if you just sort of look at margins across the board, you're going to see you get a big acceleration in gross margins. You're probably going to see it in net margins, pre-tax and after-tax. So net is the bottom line. That's the bottom line. That's the net margins. That's after everything, what's left over. So I tend to I'll look at gross margins as well as net margins, but you're not going to get too far off no matter which one you use. What was the second part of the question?
So then, is there any way to rank the results? Meaning, is a code 21, for example, better than a code 12? Is there more value to earnings growth versus revenue versus the profit margins?
That's a very good question. Well, again, so here's the general rule. We talked about this before in fundamentals. You have to remember that earnings, are only going to grow so far without revenue. So if you don't have revenue, you could grow earnings. You can have higher profit margins and have earnings flat. You can even have earnings decelerating and still have revenue decelerating or flat and have earnings growing because your margins are better, right? But there's only so much productivity enhancements you can make, and so there's only so many operations that you can close, maybe losing operations, losing operations, streamline the process. That can only go so far. That walks on limited legs. So at some point, you got to get revenue going. So revenue is also important. The real key is to get either the revenue going and growing with flat margins, or improving margins would be better. And then you're going to get the earnings and see it come into the earnings. The key is to get it all. But if I had my choice, I certainly want to see revenue driving earnings versus profit margins. But my ultimate goal would be code 33 to have everything. But yeah, I would say that it's all important, and depending on the industry too. What is the story? The story behind Apple was great products, these revolutionary products that everybody wanted, and incredible pricing power. So they were selling a tremendous amount of iPhones and iPads and iPods and iTunes, but also it was so in demand and had a category killer where there was really no competition. Later on, Samsung and there was other smartphones, but prior to that, they really had the only game in town. And so they had pricing power, and they had volume, and they had new products. They were selling more products, more of an existing product, and raising prices and streamlining the process. So the margins went from 1% to 24% over a decade. Incredible story, and that right there just told you everything you needed to know. It had everything was on the table. That should be sort of your model to look for. Now, prior to that, the erosion of Apple was eroding profit margins. That's what almost put them under. So if you really want to study, both sides of the coin, look at Apple pre-Steve Jobs leaving and then post-Steve Jobs coming back. And you're going to see both sides of the coin completely inverse. Apple's an amazing story, a case study that will be studied for 100 years from now in business schools.
On 101, quick question: if you can explain the last line of a company showing strong earnings but not paying much in taxes being a red flag, why is that a red flag?
Well, if you're really making money, that's there's accounting tricks here. If you made a bunch of money, right, you're going to have to pay some taxes. Just think of your own personal situation, right? You make $20 million this year. If you don't pay any taxes, I assure you can't. As much as some will lead you to believe that the rich don't pay taxes. That's absurd. You're going to pay taxes. All right. There's no way around taxes. So a company showing really strong earnings, but it's not coming. They're not paying any taxes to the government. Is a red flag. It's showing that there's some gimmickry there.
I would just one of the first big winners I had a situation like that. I would really check into the earnings. There was the company I bought was called Ward's, and they changed their name to Circuit City. Yep. They had a bunch of a bunch of losses, and they had this huge loss carry forward. So they actually didn't pay taxes for a number of quarters, but then they turned around their operations, and the sales really started picking up. And so that was a situation where I did have strong earnings, but not paying much taxes. You could find that on turnaround situations sometimes. So, but it's
right.
Yeah,
but it won't be long lived.
Yeah, no,
eventually
it can only last for a certain a year or so.
Exactly. There's only so long that's going. And again, looking into the story a bit, you can find out what's the reasoning behind that. This would be a red flag. Like if you were doing forensic accounting, I don't do forensic accounting, but if you were to do a forensic accounting, and most of these really big mutual funds have forensic accountants and analysts that really look deep into this stuff. So if you see a company showing big earnings, but they're not paying taxes, now that's something where you've got to now dig in. Like David went in there and took a look, and there's a reason behind that. And now you know the timeline where that should correct itself. All right, what is your loss carry forward? Okay, so this, and how much money did you make? All right, so that should be paid up. You should be paying taxes in the next 2 quarters. While while that loss carry forward gets eaten away, you can come up with a timeline there. Again, I'm not a mutual fund that I have to have that kind of informational superiority, because I can move it lightning fast. So I'm not going to really worry about that too much. But I know one thing that is a red flag. And something that you. Yeah.
Also, I was going to say, because if that also is helping the earnings look bigger than it really is, once that taxes comes back into the mix, those are going to suppress the earnings.
It's a very good point. I was just going to say the same thing, and how I was going to say it actually was to tell you that there's a book called Financial Shenanigans. There's a couple books actually. Financial Shenanigans is one of them. It's got kind of a cartoonish cover, but it's actually a really good book. There's a handful of books about forensic accounting, and there's case studies in there. And these are ways where companies will. I can assure you that a company, one of the worst places you can go for information is the company. They'll tell you anything to make things look good. The CEO is just a dog and pony show expert that will just go out there, and no matter what is happening bad, they're going to try to make it look good. The last thing they want is everybody selling their stock. So, you've got to be able to look at these things and see what's going on. It happened with LA Gear. Now, stocks can make huge moves though. Like I bought LA Gear in 19, I think it was 89, I believe, and it went up 400%. I actually gave it to my uncle who made a fortune on it. The stock was amazing. It broke out of a perfect coupled handle, had triple digit earnings, like 3 or 4 quarters in a row. I called a bunch of, I started seeing kids with these sneakers with like glitter in the laces. They were like real bright laces. And this is before anybody was doing this. Nobody had the sneakers. Like now sneakers are amazing what they do with sneakers. Back then it was just, there were Nike and there was, Puma and Adidas, and there wasn't all these glitter things or lights on them. LA Gear started doing that. And so I just called around. I said, let me call a bunch of, I think it was called Athlete's Foot at the time. I called Athlete's Foot. They sold, sneakers. And I called and said, hey, how's LA Gear selling? They were like, the guy said, I remember it was a guy in Orange, Connecticut. He said, wow, if I had 20 cases of them today, I'd be out of them by next week. We just can't keep them. And then I called a store in California. I called all around the country, a couple of stores, and everywhere I called, they said, yeah, they're the hottest thing. We can't keep them in stock. So anyway, long story short, they were cooking the books. The stock went up 400%, and then it crashed, and LA Gear had big problems. It's another textbook case that's studied in business schools now. They were getting returns, and they weren't booking the returns. So they'd sell product, and then the returns that came back, they weren't booking that. So they were actually stockpiling, and they were actually putting out money to pay for the returns, and they weren't taking it off the earnings, which I think it was illegal, but it certainly was not. It certainly was frowned upon.
Is that frowned upon? If somebody let me know.
Another one is Crazy Eddie's, which Crazy Eddie's was, if you're from the Northeast, remember he was this kooky guy who used to say, our prices are insane. He would say on the TV, and he was another one where they were not only cooking the books, but they had horrible inventory control, and they were being robbed left and right and didn't even know it. They're literally, their warehouses were half empty and they thought that all the stuff was in the warehouse, and it wasn't even there, because back then they didn't have computerized scanned inventory. You had somebody come in and check it, and the employees were robbing them and they were lying, and so it was actually false numbers. So these are just some things that, again, I don't get into this forensic stuff. I haven't found value in it. I've followed for a number of years some of the best forensic accounting managers, and they weren't outperforming. Like if they were outperforming, I'd say, okay, there's something to it. I got to learn forensic accounting. I've never seen these forensic guys, perform really well. They still have big drawdowns, and they weren't performing any better than the type of techniques that I use. So anyway, that's let's not go too much more into this. That's enough.
Yeah, remember Enron, WorldCom.
Yeah, well, that was outright fraud too. Yeah.
On page 135, just a quick review of the abbreviations. The TBs are the trap buyers.
Trap buyers, bottom fishers, profit takers, break even.
Yeah. Page 143.
143?
Yep.
Yeah.
It appears that in order to detect and track VCPs, we should start with the weekly chart, but in order to find the right buy point, we need to look at the daily charts. What would be a good discipline to develop here?
I do it opposite. I start with daily and then I go with weekly. So I think you can do it either way. It's really, if you're longer term, you might want to start with weekly. I use daily, and Dave, you start off with daily and then check the weekly, right?
Sometimes I go one way, sometimes I go the other way. Sometimes it actually depends on what I'm using. On an iPad, I use the daily. Sometimes it doesn't matter. You can find it both ways.
Gotcha.
That's for Priya. On 155.
155. Yep.
The decline on the left side from like 3 months ago is more than 50%. Doesn't that violate what you said before about deep declines, or doesn't the decline count so much since the stock recovered a big part of it before setting up in the pivot?
That's a very good observation. It's a very big base. Okay. And generally speaking, the larger declines, I'm going to avoid those. Not always, no, not always. I said if there's a big bear market, one is where if you have a really big bear market, you're going to get deeper bases. Sometimes you'll get really deep bases, something like the 1974 bear market, which was a huge bear market. You have big deep bases depending on the correction. If you remember, this is going back to 1998, and this was where we had right here. I believe this was the slide. This was the big slide. Actually, I called this crash on the Neil Cavuto show, the Friday before the Monday that we had the big slide in the market. So this was a market, slide that had the stock down for a very short period of time. It did recover. I sort of looked at this as the real base right here was right around, and again, these are adjusted for split. So it wasn't trading at $4 at the time. It was higher price, but I looked at it as around the $4 range, coming off, from about $5.50, and it was very short lived. And there was a market meltdown at this time. So that I cut this a little bit of slack because it was just such a perfect setup. I mean, this is as good as it gets. Really just a perfect little pivot point. I got the fractals, everything just right. So I did cut this a little bit of slack, but I was wondering if they were going to, every time I put this up, I say to myself, I wonder who's going to say, okay, that's more than 50%. And that's a good catch. And that's why we have these up here. We want to see the real trades and to discuss, anything that you see. There's a reason behind it. I'm doing everything for a reason. I'm not missing anything. I can tell you that right now. I'm aware of it, and there's a reason behind it. And it's good that we talk about it.
Yep. On slide 158, in the volume box, the person asking, what does it mean with it showing the clipped at the RMS volume times 2?
The clipped is just where, because the volume is it would be so big that they just put a cap on it. So if it goes above that point, it's actually bigger volume than that, but it put a cap and peaked it at that.
Yeah. So
that's not a true reading of the, it actually would be, this volume would actually be much larger in relation to this volume, but it's large enough. This is large enough to see the contrast.
So without that, all the other bars would be so small to not be able to see them easily.
You won't even see them.
Mark makes that adjustment, so it just goes up 2 times. And what is your volume moving average on the volume? Is that 50 days?
Usually it's a 50-day that I use. On here, I believe it's the 50-day because this is my chart. But I use a 50-day average volume.
Page 192.
192?
Right.
Yep.
When buying from a cheat or low cheat as the stock approaches the pivot, do you A, keep a tight stop in case the handle forms and you don't want to stay in for that because it's wasting a lot of time? Or B, do you keep a lenient stop and try to ride out a handle and keep moving upward?
Well, that's very vague. First of all, lenient stop. Look, I'm gonna sell the stock based on the prevailing math of my own risk reward. My reward side is going to dictate my risk side, and I'm gonna hopefully I'm backing into those trades that technically will be within those mathematics. If not, I have to use a mathematical stop. But I'm not treating it any different than the handle or any other pivot. It's the same exact thing. I'm not differentiating between a cheat, a low cheat, a handle. The only thing I might change is if the low cheat has a lot of supply that's going into, I might just position size smaller and pyramid into the stock and buy a little bit. And then if it works, and it sets up another pivot, buy a little bit more there. That's really the only way I treat, each pivot differently. Other than that, the risk is going to be based on reward, and I'm not really penalizing or giving, leniency to one pivot versus the other. No. I don't know. How about you, Dave, as far as, buying lower, whether it's, we call it a cheat or not, just a pivot, maybe within the lower part of the base and the lower third or mid up to the handle versus the handle. You changing the stop or anything, or is it pretty much kind of the same decision making?
No, well, I mean, the good thing about buying when it's technically set up like this example you've got on the screen is that you've got a real nice spot of where to get out, and so yeah, nothing really changes. And that's what's so great about buying something that's really, really tight is that lots of times your stop or your sell point is even less than the 7 or 8%. So
right.
No, it doesn't change.
Yeah, we're not 7 or 8% isn't what we're shooting for. We're shooting for the tightest stop that we can without choking off the trade, though. We want to give it room to act normal. So when we back into a chart that's very tight, that means that we can let it act normal, but not take too much risk. That's why we go in. Now, that's from just a risk reward standpoint, but the real reason why, the key to the right side being tight is, of course, for the supply stop coming to market and to time it where it can be explosive. So there's multiple reasons behind that tight right side.
Question from Ephraim asking, David, do you use Mark's cheat and low cheat entry? And if so, when did you start using the pattern?
I actually probably started using it when I started doing the workshops with Mark. As Mark said, I picked some of that up from him. And I think it's something that with all of this, you have to start slowly. And if you wait until it gets all the way up near the highs, I think that in a lot of cases that might be your lower risk point of buying. Mark and I can go back and forth on this because sometimes if you don't read the cheat correctly, then you've got some overhead that you've got to get through. So
Yeah, I think two things, Dave. Two things that I should say. That Dave, for the first couple of years, he was like, "Should we really show this? This is advanced, and this might be hard for them to do." I think over the years, he's warmed up to it a bit more, and that it's not maybe as difficult. However, it's certainly when you get and Dave, you can. We're talking semantics here. I mean, a handle can be 5 or 10% below the high, which I would call a cheat, but Bill O'Neill would call it a handle.
Yeah.
So it's, when you really start talking really a Mינארוווני cheat, it's got to be really low, like it's got to be in the lower 1/3 or at least in the mid 1/3. Even if you're below the high, let's just say the base is 40% deep and you're 15% off the high, that's a handle. That's not, a cheat. This is semantics though. And what Dave is saying is that when you get down and you get low down there, if you get it right, yeah, but you're dealing with that overhead supply, you see, and now you've got to get really good at analyzing that left side. It's like going across the street. If you go across the street with not many cars, the chances of getting hit are a lot less, right? But if you're going across the street with a lot of cars whizzing and you're going across a busy highway, now you've got to be a lot more careful. Look both ways and time it perfectly. That's sort of what I always say, look to the left for traffic. That's where all your traffic is. What Dave is saying is that when you're near a high, that traffic is eliminated. So it's a higher probability setup from that standpoint. Now, but when you're lower, you trade off the higher probability with the supply being gone by where you have a bigger potential gain because you're getting in lower. So it's, you've got to, the cheat and particularly the low cheat. The low cheat you should be really careful with in the beginning. If you're just starting out, I would not play the low cheat. I would stay away from that and look for them to set up in the mid third to upper third of the pattern on the right side. The lower third is really a more of a professional, what I call a professional buy, an expert buy, and work your way back. Don't try to buy at the lowest point. Look at full setups and then look back and say, okay, was there an earlier spot? Was there an earlier spot to get in? And then start seeing the various buy points leading up to the handle phase.
And one
Bob,
last.
Bob, you wanted to talk about wedging.
Okay, before you go there, one quick point that I want to also emphasize, guys, as the question was being asked, yes, you have a cheat entry. You don't know that there's going to be a handle. You could just go straight up. And so you're saying you're worried about it going to a handle and your money's going to be dead while it's building a handle. What if it doesn't and just goes straight up? So don't try to outthink the market. Okay.
Right. You're dealing with it at the time. That's all you have is the information you have at the time.
Dave, what would be a wedging?
This is what I call wedging. If you go to Twilio, TWLO, this recently has been doing it. And what wedging is it's just a slow upward movement, and usually under, and almost all the time under moving averages. And you can see it. I can't see I guess it would be coming in at 330. Yeah, right there, right where you had it right there. Now go back 4 days to the right. You're 4 days to the right.
4 days to the right over here.
Yeah. That's. I mean, yeah. You can draw the
low.
Yeah, you can draw it from the low. You can draw it, but what it is that it's a weak rally under moving averages, and the stock has made a top, and the top occurred between like 370 and 410. There you go, and so it rallies back on lighter volume, and it rallies back under the moving averages into overhead supply, and then you can see it did it again. Go to the next low, which would be at just about 330, and draw that going across.
Mm-hmm.
There you go again. That's wedging, because what happens is the stock breaks in about 3 or 4 days, and then it takes 6 or 7 days to get back what happened in just a couple of days, and then it breaks again, and it keeps on doing that, and it's just a weak pattern. Now, that's on the downside. On the upside, we'd probably have to go back a number of months, but it works the other way. When the stock is in an uptrend, there's a good one going from about like 372 down to 320.
Now here's a good example too, Dave. Not to interrupt, but right here where we're getting the proper drift.
Yes. See,
that's proper. That's drifting back as opposed to wedging.
Yeah, and you can do it from the next high down, where it's three, like at 3, looks like 379. Yeah, right there. See, and that's what happens on when the stock is in a proper uptrend. It moves up quickly and then it drifts down, and it's sometimes it does take a wedge, a triangle type of pattern, but a lot of times it's just a drift. And it drifts down, and then it runs up quickly. And so that's why I always say, when you're going to really learn how a stock acts, is take a big winner and go day by day and look at how the stock acts during the entire uptrend. What do the rallies look like? What do the declines look like? What are the moving averages doing? What's the price? What's the volume doing? And then just draw a line right at the top, and then study everything on the right side of the chart during the downtrend. And what is the characteristics of the stock when it's in a downtrend? Because the whole picture it just flips itself completely, and is an entirely opposite on the uptrend versus the downtrend. And if you can get that the way that stock acts during those two periods of time, you're going to have a great idea if you're in an uptrend or a downtrend.
Yeah, and Dave discussed this earlier when in subsequent days, in previous days, where we showed this. It was a particular, I forget what section it was in, but he showed that contrast of the uptrend versus that. I believe it was in the trend section. But again, to go further here, you see again, here's your base, right? And let's just take a look at this. So you've got your low cheat right here, you got your cheat right here, and then you build your handle. So again, this is where I was talking about, where when you get that low cheat, you see if you run it right across here, there's the pivot right here, right? There's that little couple day pivot. See, you got supply to contend with, and that usually will stall the stock out. See, it can't rally much, so it stalls out a bit. Now it rallies again out of the cheat. Now we move this up. Now we have less supply, you see, and it rallies again, but we stall out a little bit more because once again, we got a little bit of supply, right? We're back up. We're got those last trap buyers. Now sorry about that. Get that out of the way. Now you come out of the handle. You drift back, you get those last few weak holders out. Boom. Now you see you're breaking out strong. You drift back to the breakout, and now you get the first natural reaction. Second natural reaction. Now, see, remember I said you get third, fourth natural reaction. Now you start undercutting previous lows, and you go through bigger corrections or maybe even top. But now you've gotten just a very short period of time. You bought it off of this cheat or somewhere around here. We're looking at just a couple months. It's up 50%. That's a nice little move. That's a nice 2-3 month move. 50%. That'll really tack on some performance for you. But this is just classic, classic little setup, little base setting up here, and you've got all the elements, coming together pretty perfectly. Go ahead, Bob.
On page 195, quick question with regards to the big volume day at the end of June without much price action. How do you interpret that? But I have to caveat that the end of June is always the Russell rebalancing day.
That was probably a rebalancing, yeah.
You do get these huge volume spikes that are not really to be evaluated so strictly.
Yep. So you have to look at that, and if that was a Russell rebalancing, that could have been the case there, and probably was. Yep.
That Zillow chart is shown again on 225, but so it'll be the same spike there. On page 220, there's that same end of June spike.
Yeah. Although now we've got bigger volume here, so it looks smaller. But yeah.
Right. On 220, though, going back, could you elaborate on what good closes versus bad closes mean that you guys were just talking about? Upper range of the day versus lower on or up down on volume.
Well, the higher in the range, the better. Okay, so if it's the higher in the range is a good. I determine a good close, and I would think David, you were saying that it's going to be in the upper half, right? And the better, the more closer it is. I mean, this is a good close. This is a good close. This is a neutral close. This is a bad close. This is a good close. Good close. Say neutral. Decent close. Good close. So I would say there's 1, 2, 3, 4, 5. There's at least 6 good closes here and 2 or 3 bad closes. So that's fine. That's acting perfectly fine. Up days, 1, 2, 3, 4, 5, 6, 7 up days out of 9 up days. That's fine. I like to see, 70% of the days on the upside is really what I'm looking for. 70% or better. 7 out of 10 or even 6 out of 10 is good. 60, 70%. So, this is acting fine. And what this is telling you is, you should try to hold through that first natural reaction and see if you can play it for a bigger move because it's acting right.
Page 227. On this slide, Mark, you referred to the term the MVP. Can you or David explain what is that criteria again?
Okay, well, it's right here. Up 20% or more, 12 out of 15 days, right? You want to have the stock up 20% or more. 12 of the 15 days are up. And during that time, Dave, his estimate is that 20% increase in volume, at least over that period. But you want to see, volume increasing, certainly on the up days, and see that contrast. But really, it's the number of days that it's up versus down and the net progress. So the net progress should be, you're up 20% or greater, and you have 12 out of 15 days up.
Yeah, and the bigger the volume you get, the better. Because if it's lighter volume, that's telling you that there's not a whole lot of institutions in there buying it. What you really are seeing is you want to see big volume increase during that period, and I think I've said it's 20 to 25% above average daily volume. And so if average daily volume over the last 50 days is 100,000. You want that stock to be trading on average, 125,000 shares a day or more. as it's going through those 12 out of 15 days. So it's what it is you're looking for institutional buyers who can't buy in one day, but they have to do it over 2 to 3 week period of time. And there's usually more than one at the same time, and they're buying day after day after day after day. And they don't care. A lot of them aren't buying and stopping their buying when the stock gets extended. They have to fill. Look, the portfolio manager gives the order to the trader and say, look, I need 3 million shares, and the stock only trades 300,000 or 400,000 a day. They've got to do it over time. And so that's what you're really looking for, is the big elephants that are walking through the market buying up these stocks.
Yeah. And they might say buy it up to 60 or better. And they'll try to, get the best they can, but they got to fill that order. And if it starts getting away from them, they got to buy it. They want to get that position on. They need to slash and burn. And so the more power that you have, and when you see that power, it's just telling you that there's big buyers in there. And that's what happened here with Google. And you can see this came right out of the cheat area. That's a low cheat, perfect low cheat. And I love the low cheat for recent IPO bases that are big cap names. I love big cap. These big cap IPOs that either fail initially and then set up a primary base, or their first primary base, and you get that low cheat, and they come right out of there, and you can see same exact everything, same exact rules, 7 days in a row up. Look at the natural reaction, just a couple days and you're back in the new high ground. Tennis ball action, rally some more, just a couple day natural reaction. Tennis ball action. Like, this is giving you everything. This gave you the 12. Once you get past here, you got the 12 out of 15 days, and then of course this looked like this was on earnings. Takes off even more, and now you've made a big move here. You're buying it around 50 something. It's already a double. It's less than 2 months, and you're up 100%. And why? Because that was the birth of Google. And there you go. It was big institutions buying it in there, and there's probably institutions that still own that name to this day from some of those purchases. I wouldn't doubt.
On page 246.
246.
Question, would you buy the pivot reset at the new pivot around 1440, or would you wait for it to take out the high of the initial breakout around 1475?
Yeah, so you break out here, and then you get this reversal right here, and then you shake out and you reset. And the question is, do you buy it when you're taking out this high here, or wait for it to take out the high of this reversal? In this particular scenario, and this is a stock that I did not trade. I did not trade either of these. It's just an example that I used. If I were to be trading this, and whether I bought it here and got stopped or not, I would be buying probably half of my position when it went through here, and then I would wait to see if it can get through here, and I'd buy the other half of my position. So I would have it right. My average price would be right in between. That's probably how I would do that. And if I had if I was forced to buy it one way or the other, I'd probably buy the whole position coming through here. And if it didn't come ripping through there and get through here, I might just reduce, but I'd be watching it very carefully coming into this reversal. I would be watching it very carefully when it came out here.
Okay. On page 252. Question being asked if you could explain the difference again between the pivot failure versus a base failure, and also what exactly is the turn and the squat.
The term?
The turn.
The turn.
And
all right, so
those.
Let's first start off with pivot failure versus base failure. Pivot failure is when you take out the low in the pivot point. And you break out first. So you break out, and then you come back down and you take out the low of the pivot. So if you break out, well, let me zoom up on this if I can. Can I zoom up on this? Hold on, let's see. Nope, I can't. Oh yes, I can. There we go. So right here, when we break out here, so that low in the pivot, and see, this is perfect. See how it drifts down, like David and I were talking? That's perfect. Drifts back, breaks out here. So that low, if you take out that low, that would be a pivot failure. A base failure, you'd have to come all the way down and take out that low. So in this particular case, you had right here, you broke out here, you got a pivot failure, it recovered, and then you got another failure. It just got wider, which really made it look bad. And now you went into a full-blown base failure. You took out this low, and that's why it took so much longer. And then finally, it set up very nicely over here, and you got a cheat area and you got a handle. You got both of those. Now, the other question was
if you can just define the turn and a squat.
Yeah, the turn. So what is the page? Well, the squat is just simply where you break out and then you pull back and you close below the mid of the mid of the range or below the mid of the range. That's all. It's just a close in the lower part of the range of the bar after a breakout. Now, and again, that was what was the previous slide we were just on right here? That's a squat. That's a squat. You break out and then you squat. You sit all the way back down. You sit on the lower. You sit down in the lower end of the range. That's a squat. The turn. Where's the Bob? What slide is the turn on? Where we talked about 3C right here, right? Yeah, here it is. Okay, so the turn is something that I've termed a long time ago. It's simply when you're in a confirmed new uptrend. See, standard technical analysis tells you, if you were to go back and look at the trend line and all that stuff. I don't use trend lines, breaks of trend lines to determine when the trend changes. I'm looking for what I call the 1, 2, 3 change of trend or making the turn. So in order to make the turn, here's the problem, and this is a subject we can get into really depth. I almost put this in my book, but it was just too much and too esoteric. If you buy a stock when it breaks the trend line, what happens very often is it breaks the trend line. Then it turns down, it takes on the low, and it's what I call a redefining trend. It just redefines the trend line. So now it takes out the low, and now you take the trend line and you draw it above here. And now it takes out that high and then comes off. If it takes out the low, now you just redraw the trend line. The trend line gets higher and higher, and the low gets lower and lower, and the volatility just increases more and more. And by the time you're buying the trend break, you're buying it way off the lows, and it hasn't even shown you that it's a new uptrend is really intact yet. So what I found by analyzing price of literally hundreds of thousands of charts is that the trend line doesn't give you the symmetry. And this is another thing I learned from O'Neill about the symmetry, where you got to give the stock time to go through time. And O'Neill got it from Livermore. Livermore talked about time and price, how time was as important as price. I'll give you an example. A stock goes down real fast, right? You buy it, bang. We had that question before. What happens if the stock earnings comes off 15%? What do you do? See, you're thinking about not selling it because it's so fast. It's so quick. Maybe this is a quick, just reaction, an aberration. Time will wear somebody out more than price. Now, just imagine you bought a stock and it went nowhere for a year and just stayed flat. You'd be selling it. You'd be, that would wear you out more than a price moving down real quickly. And say it goes down 10%. You might say, hold on, let me just give it a chance here and see what happens, because the time element is equally as powerful. So when you're going through these corrections, time wears out these weak holders. These trapped buyers, and wears out the buyers off the lows. All this supply gets worn out with time. So there's a certain symmetry that it's quite amazing. I don't know, Dave, you talked about this before in past MTPs where we talked about how the right side tends to be the same length as the left side. There's a certain symmetry that happens, and I don't know exactly why, but there is a balance. So anyway, I'm going to answer your question first, and then I'll let Dave talk about that. So the turn is made when you break a trend, then you pull back. Okay, you have to hold above the low. You pull back and then take out the high of that trend break. So you as you rally up, you make a little high. As you pull back and you put a pivot in there or whatever it is, when you take out that high, that's the turn. Now, the turn could correspond with a pivot or a correct buy point, but it doesn't have to. It could be a compressed right side, and it happens very sharp up the right side, and it just doesn't have the symmetry yet. So that's where you have to start ascertaining the quality of the base. See, when you look at a chart, it's just like grading a diamond. You can't just look at a diamond and just say by the size of it what it's worth, or by the color of it what it's worth. There's cut, clarity, there's polish, there's carat weight, right? The 4 C's. So you're going to look at that diamond. What does it have? Inclusions? What's the dimensions of it? How good is the table? The girdle, the depth of it, the width of it, the color. All those things are now. Then you grade it and you say, this is a perfect diamond. It's flawless. It's a D color. It's got a perfect proportions. The same exact thing with a chart. You got to look at it, and there's a number of elements that you're looking at to grade the quality of the digestion of the previous uptrend, of whether this consolidation is constructive or if this is abnormal and it looks like there's lots of supply. And this is all about determining supply. It's all about determining supply. Like I said, when I go back to Bill O'Neill and he talked about supply not coming to market, boy, that sentence was worth $10 million to me. When I finally got that, I made a fortune. But this is what this whole time, this is what we're talking about, determining. So this is part of it to try to get you to, I came up with this because, again, I saw so many people buying too early and not really understanding when the trend truly was in a new uptrend. And this is the confirmation, is that you make the turn. Sometimes the pivot is below the turn, and you start buying a little below before the turn is made. And then the turn confirms that you're now moved into a new uptrend. That's a long answer, but that's the answer. Dave, as far as the symmetry is concerned.
Well, it should be, when we talk about cups and handles and bases and things like that, they should look like the description. And I've always said too, you can get very confused in looking at different patterns and looking for double bottoms and cups and handles and all these different things that I've said, and you can see it. Just draw the line.
There's the line right there.
Just make it simple on yourself. Don't worry about all the stuff that's going on below that line, but where the majority of the base is built, that's where your buy point is, or your pivot point is, because people tend to make it so complicated and they think they should be seeing these things. Cups and handles do not show up that often. They only show up after a decent correction in the market that brings stocks off, 10%.
Right.
So
look for the tightness in price, the volatility contraction, and draw that line from the pivot, and look where the supply is, and look to clear that, and more importantly, relate that volume to the price action. Look for those tight right sides coming from nice symmetrical consolidations, and you get good at volume analysis with the price, and you stick to those tight right sides, and you're going to be amazed. You're going to get yourself on some, you're going to grab some tigers by the tail. And manage that risk. But I agree with Dave 100%. We get so into semantics, and so many people, what the things we say, they take it so literally. Between all these different things, you can get very confused. That's why I keep on saying I'm gonna write a book someday, and it's going to be one chapter, and it's going to be one line, and it's going to be called Draw the Line, and it. That's it. Yeah, nothing else. That's all you have to do. I like it. I like that. I like that concept for a book. Draw a line.
Draw a line.
Actually, we got a comment from David who says the founders of Skechers are the same. Were the same owners of LA Gear.
Ah, that's interesting. I did not know that.
Which would be kind of funny because they certainly know the shoe business.
That's pretty interesting. I did not know that. I'm going to look into that. That's interesting. So your new book, Dave, how I made millions, drawing a line,
drawing a line,
drawing a line, and how you can too.
Yes.
Yeah. All you need is a pen. The new technique, by David Ryan. All you need is a pen and a ruler.
And a ruler. Yeah. I'll put the ruler in the back of the book as a bonus.
There you go.
You can find your own pencil
included. There you go.
Yeah.
That's awesome.
Mark, back on 252 again, though.
Yeah.
Another question. Mark said a number of times that the base was sloppy, including the V-shaped base for Baidu.
Mm-hmm.
On this page, my understanding from his books and the program so far is that the base is sloppy if it comes up too quickly on the right-hand side. To my eyes, the base does not look like that and looks decent. What makes a base good and actionable? What makes it sloppy?
Well, this wasn't a completely off the table base. All right. It did not come up the right side too fast, but it is very V-shaped. So it did come up fast, but it went down fast. So the V-shaped nature makes it a little more failure prone. It could work. And Dave, you've seen a zillion bases, and I know I've discussed this with O'Neill a few times, about V-shaped, and they can work. And even cups with no handle can work. All right, that can work. But in all the times, Dave, that you've seen, stocks come out of these bases and all the bear markets I've gone through, I believe 8 bear markets now. I've not seen really like this I haven't had to use V-shaped bases, or I'd missed the or compressed right size, or cups with no handles. I mean, that's like really, really rare, right?
Yeah, it's usually when a stock comes up, and especially if it's a deep pullback, that it's got to rest before it goes into new high ground. And if it comes up too quickly, then it just lots of times it seems like it runs out of gas, and if it breaks out, it fails. But if it comes up and builds a handle or some kind of drift and rests for a little bit before then going into new highs, then it's a lot more. You're a lot more chance that it's going to work out.
See, again, you have to understand what we're trying to accomplish here. We're trying to ascertain and allow the stock to go through enough time to weed out the supply. Again, it's all about eliminating supply. This is supply and demand. You're trying to time a stock at the point where demand dramatically outweighs supply. It's as simple as any other. It's like the law of gravity, the law of supply and demand. It's a very straightforward calculation here, if you want to call it. So time, is going to allow you, like if this stock comes off real quick, back real fast, well, there's a less likelihood that you've worn out these trapped buyers. Now that gives you more supply. When you come up this right side, that's why it's squirming all over the place, right? Because now you haven't weeded out those trapped buyers. So now you've got supply, you got sellers that are coming in here. But now that you go through that, and then now you come off again and you undercut these lows, which is going to shake out a bunch of people that have their stops here, and you go through now a bunch of time, you see now you've put in a lot of time and a lot of price action, you undercut a lot of lows. All those weak hands are now getting the towels getting squeezed and squeezed and squeezed. And then when you finally see this orderly right side, that's not the cause. That's the effect. So you have to understand, this is not, because it does this, that's why it works. No, it's doing this because the supply has stopped coming to market. This is giving you the indication. That's what's telling you that the supply has stopped coming to market. You understand? It's the cause. It's not the cause. It's the effect. That's what you have to remember. These patterns are the effect. Some people think, they work because everybody watches them. No, it would be just the opposite. If everybody watched them and it worked because everybody watched them, they wouldn't work anymore. Go ahead. Let's go to next, because we're running out of time here. I think we're going on 3 hours now, right?
No, we're going on 4 hours.
No.
Didn't you start at 7:30?
No. How long are we going, Bob?
Bob's on mute.
Where's Bob? Uh-oh.
Most famous.
There you go.
The most famous line of the year. You're on mute.
Yeah.
You're on mute.
Next page, Brody, 253.
So what, another 5 minutes? Mark. Is that it?
Yeah, 5 minutes.
Okay.
5 minutes?
Actually got one
what
last
page
question.
are we going on? Huh? I'm sorry.
253.
253.
Just real quick here, Spirit Airlines, how do you differentiate this dip from a ledge?
Well, a ledge, this has not broken down yet, really. If you broke down from here, then, that would start. This is definitely very creative. This is really getting about as creative as you want to get with a low cheat. And that's why, Dave was just saying, this can be dangerous. You really got to know what you're doing. You got to be quick on the trigger. If you get it wrong and they start selling off here, yeah, it starts looking a bit more ledgy. A ledge is more of a broken, this doesn't have the look of a ledge, although yes, it is. I would say it's a little ledgy. Let's put it that way. But this is more of sort of a little low cheat. It looks more like a cap that just came in a bit. I have to look at the market. Like if the market was weak here, I might cut this a little bit of slack. But again, this is very creative, very creative. If you look at the ledges, and we have where are the ledges, Bob? Oh, here's a few.
Right. Yep.
You see that this has a different look. You see how it has the base here and it breaks and then kind of goes straight sideways. Here's another one. See here where you get that sort of same look as we just saw with Spirit, where you got the little pivot right here and this sort of little reset, but then it breaks. And now you see you form the ledge here. You see these ledges? Let me see. Is there any more? Yeah, right here. You see how it tries to break out, and now it's still okay here, but now it breaks, and now it can't rally. See that's the ledge. That's really the classic ledge. Here's another one. See, this comes down real hard, 8 lower lows, and then just can't rally. Go straight sideways. That's more of a ledge. Here's another one. See here, you break down, and then you roll over here. You just go sideways, and you can't rally. So it's the thing about a ledge is that what happens is to really ascertain this is, and this is again, I'm really noticing how much O'Neill influenced me in so many ways here. Today, I'm drawing upon so many O'Neill things that he said during the few times that I was able to meet him and discuss things. You could. I'm not sure if you can read about this, but O'Neill personally said this to me. He said the worst thing a stock can do is break and not rally. And the best thing a stock can do is rally and not pull back much. So again, it's counterintuitive because like when a stock breaks out, most people are like, I'll buy it on a pullback. But the best ones don't pull back. And when a stock breaks down and you're at that big loss and it blows through your stop, you're like, okay, when I get back to even, I'll sell it and I'll get out. The real troubled stocks don't come back to break even. They keep going. They break down. So when you have a stock that breaks and it can't rally, it's telling you this is really weak. When you have a stock that breaks out and doesn't pull back much, it's telling you this is really strong. Hence the violations and the confirmations. This is why we're using these. See, again, we didn't come up with this stuff off the top of our head. David and I just didn't say, oh yeah, well, if there's more up days than down days, yeah, that's good. Let's tell them that this is what we've learned over 4 decades, more than 4 decades, David has. I have just under 4 decades of doing this. We've honed it down to the absolute most important things to look at that can get us to the answer in the shortest period of time, what's really relevant. That's how O'Neill was so groundbreaking and so amazing, is that he could distill everything down to, and that's what Cancelim was, where you distilled it down to the characteristics that worked. And Love did this. O'Neill is just a repackaged Love and Giller. If you go back, and those of you don't know what I'm talking about Richard Love, Super Performance Stocks, the book, and William Giller, who had the book How Charts Can Help You in the Stock Market. O'Neill didn't come up with the cup and handle. He retermed it. It was actually called the Saucer and Platform in Giller's book. Giller's book is, I think, the most groundbreaking and most amazing technical analysis book ever written. And it's particularly because when it was written, and there's just nothing before him. So take a look at Giller's book and Richard and Love's book, and you will find Cancelim. You'll see and Bill O'Neill studied them when Bill O'Neill was actually the worst performing broker at Hayden Stone back in the 60s. He was one of the worst performing brokers there, and he studied his mistakes and said, what am I doing wrong here? I got to get disciplined at this, and I got to get some rules, and I got to find out what actually works. And he was one of the first to use computers to factor model. And factor modeling is not back testing. There's a big difference. Factor modeling is looking at the winners, looking at what produced the result, and then looking for commonalities. So like if you were to go and say, let me go look at all the gold medalists. Let me see everybody who won a gold medal. Is there something that they all were doing similar? Like, is there a certain training program? Do they have a certain diet or food that they eat? What are the commonalities? Back testing is to go and just test everything and to back into a result regardless. All right. You're just looking at whatever. Okay, let's just study everything. We find, when beetles, scurry around in this direction, the market goes up. And when the football indicator, that's back testing. That's called curve fitting. That's why it doesn't work. By the time you figure it out, it's the next best thing. Something else, works for the next decade or whatever. So, but factor modeling is actually looking at the commonalities of the performers. So, again, I don't even remember where I started with the question. What was the original question, Bob? I do this all the time. But it always goes in a great place.
Yeah.
What was the original question? The ledge?
Well, the question was how to differentiate the dip from a ledge. Yes.
Yeah, the dip from a ledge.
Spirit Airlines.
Yeah. So, but the bottom line, the moral of this whole thing was where I went back to Bill O'Neill saying, when the stock it can't rally, it's when it's weak. When it can't pull back, that's when it's strong. Here's what most people when the stock breaks, they're waiting for it to come back, and that's why they get caught. And then when the stock breaks out, they're waiting for a pullback. This is why I said before, you got to learn to buy the stocks at the right time and not come up with techniques to buy them after the breakout. Because when you're starting a new bull market, you're not going to get that opportunity. The best ones are going to be gone. They're going to take off and they're going to be gone. If you go back to my interview in Stock Market Wizards, when Jack Schwager walked into my office, I was in the middle of a trade. I was buying a stock, and he comes in and he asked me, "What are you doing?" I said, "I'm buying a stock." And he says, "Really? Tell me about it." I said, "Well, I can tell you one thing. I hope I don't get a good fill." And he was scratching his head going, "What do you mean? Don't you want to get the stock?" I said, I would rather put in an order for 10,000 shares and have him tell me you only got 4 and it was hard to buy. Then I put an order in and they said, "You know what? You got 50 cents better." That's the worst possible thing. That means that I didn't time it right. That means there's lots of supply there. They're giving you all you want, all you can eat. You want that stock to blast off and be gone. And this goes right back to what Dave said. The best trades are usually the ones that you're at a profit right away, and they're hard to buy. And that's, that's where we are. This is all about analyzing and figuring out the supply demand dynamics. If you get good at figuring out supply demand, you don't need anything. You don't need the fundamentals. You can trade right off of charts. I just think that why not have all the elements? Increase the probabilities? Know everything that you can know about the situation and increase the probabilities. Bring every tool that you can, and that the fundamentals are going to also increase those probabilities. So, but there's people who trade pure technicals. I know one thing. You just give me charts, and I'm going to make money. I'm going to make money if you just slid unknown companies and I didn't even have ticker symbols. You just give me the charts. I'm going to make money because I understand the nature of price movement.
Last question, or perhaps page 148. This was the reference of a good example of wedging as well. Is this chart showing the wedging of the right-hand side here?
Yes, and it's wedging, and you could talk about this too if you want, Dave. It's wedge. See, there's a lot of things here. If I didn't point all this out, you wouldn't see all this, all right? There's a few things that you wouldn't see. First of all, this correction right here, it's not only 50%, but it's during a time where the market's only down 10. So this is way underperforming the market. All right, that's number one. So I always plot the chart over the market and see what's happening versus the market. This is way underperforming. That's number one. And as Dave said, once you're down 50, 60%, when you come all the way back, now the stock has to double just to get back up there. So anybody that bought it down here, I mean, you're at 100% profit a month later. That's a big profit. And you see, it hasn't drifted back. So you're not weeding out those last few holders. It's got this is all the wrong elements here. But to an amateur, they'll see this and go, hey, this is a cup with a handle.
Yeah, nope. I would say that I wouldn't label that a wedging rally. That's just, I mean, everything you said was correct. It corrected way too much. It was over 50%. And by the time it came back up to anywhere close to the breakout, it had run out of power. Yeah. My wedging is after the stock has broken and it's below moving averages, because I don't really, I mean, that handle looks okay, but I think it was just the correction was just way too big. And the stock ran out of power. I see the wedges occurring after the break. If you look at it right where it says August, they're wedged for 4 or 5 days and broke again, and then it kind of wedged there. Yeah. So
Dave, I agree with you. And I would say to Dave's point that let's just say this correction was only 20% and this was more flattish here and you didn't have this excessive, I could definitely be buying it here. And I can see why somebody could buy it here because it's tight on the right side. But you have to take all this into consideration. And with the excessive correction, you're more prone to failure. It doesn't mean that you don't maybe completely stay away from it. You could try it, but you have to realize that you're in a higher failure prone situation. And because you've got such a big correction, it could fail fast. And that's what happened here. This just came crashing down and you had a huge loss. That's why, it's all about probabilities. If you're playing in that heavy traffic, you're going to get hit by a car. You want to find that street with not too many cars racing around and that quiet horse that's not a bucking bronco to take you to the other side of the corral. If you go playing around, what they say, you roll with pigs, you get dirty, right? So you got to be careful about getting into these situations that are more risky. So, again, we could go through this and analyze this stuff, over and over and over. And there's so many nuances, but we're trying to really hone you down to, a set of principles and parameters that are repeatable and that you can see and that you can count on. Does it mean that a stock that's down 70% isn't going to double to the old highs and then go up tenfold from there? No, it'll happen. That'll happen from time to time. We're talking about, can you do it consistently? Can you do it consistently? And can you do it with managing the risk in relation to the reward? That's the real question. And that's the real goal, is the consistency and managing the risk reward relationship. So we can go back in Monday Morning Quarterback and see all kinds of things that happen. Someone wins lotto every week. Doesn't mean you can make a strategy out of it. The name every week is a different name. Okay. The same guy doesn't win lotto every week. Just keep that in mind. There's someone hits, every day, a 1 in a million thing happens somewhere. But it doesn't happen to the same guy every day.
Yeah.
With that said, I know, guys, some of you, we were not able to answer every question specifically.
Not even close.
And not even close in that matter, even though Mark actually did extend a whole extra hour. It's 4-hour session that will be replayed tonight at 6:30 Eastern time. But it is something where these are the key questions that we know from doing this for many, many years of what is going to be the most helpful for you.
We did 4
hours. And having said that, there will be additional question and answer time on Monday, the trading day, November 22nd. So with that said, we hope you did enjoy today's session. I know a lot of you wrote a lot of comments. Great event, but also tons of golden nuggets. That is the whole goal here, to help get the information that you need, that Mark and David know best of what you need in order for you to be successful. And that's what the purpose is of this session. So with that said, we're going to wrap it up here now. We'll see you on the replay for those that want to come back at 6:30 Eastern. And we'll pick it up again at that time. Thank
Yep.
you,
And
David.
I want to say,
Thank you, Mark.
I want to say thank you to David. Thank you very much for taking all this time after you're already on for a couple hours on. You had a heck of a day talking about stocks, huh?
I know. I haven't had breakfast. I haven't had lunch yet,
wow.
so I'm ready to.
I had a little tiny bowl of oatmeal, and that's it. I'm starving myself. So let's go get something to eat, recharge, and then we'll see you back on the next day. And then, of course, we have the weekend for the curriculum, and there's still a lot more to go. And actually, it's going to get much better. If you liked it up to this point and you've learned a lot, wait till you see the final day, and then we have live trading. There's still a lot more to go. Okay, so truly a master trader program. We'll see you soon.